Welcomed by investors in that Spanish lender. The CAC current over in France pointing lower by 0.4%. Again, as Francois de Villeroy, the central bank governor, of course, of France, and also a member, of course, of the ECB's monetary policy governing body, saying that 4%, where we are right now, is appropriate for the ECB. He wants to see those rates held at levels of around 4%, saying you can rule out cuts at least for now. Here's the pricing around WTI then, $92 a barrel, a gain of about 1%. Brent, again, sniffing the edges of $95, as we hear from Chevron CEO suggesting that $100 a barrel is certainly in play. Across your sectors then, and just a reminder, the benchmark here in Europe pointing lower by 0.2%. Tech is down 0.4. Here's the energy play then, up 0.2%. We look at financial services as well in this environment where yields are just ticking up slightly across the US Treasury curve. The call from Alliance Bernstein that maybe you get down to about between 2.5% and around 3% on that 10-year yield next year. The cuts, they say, will come through. The bond bulls being joined by Alliance Bernstein, but that, of course, remains a live debate. Basic resources flat, losses across construction of around 0.6%. Utilities currently flat, or losses about gains of about 0.1%. And the focus really is on what's happening in energy, I would argue, but also industrials, down 0.4%. And the losses coming through from tech and the consumer as well, down between 0.5 and 0.7%. So that is a little bit of a picture across your sectors. But again, we focus on the macro data with CPI out of the UK tomorrow, the Fed decision, of course, on Wednesday, and of course, the Bank of England on Thursday, followed by the BOJ later on Friday. Anna.
Yeah, European equity markets then just tracking down by 0.25% this morning. Let's get to some of the drivers of that activity. Eddie van der Veld joins us from the Markets Live team. And Eddie, we've had a few different views on oil this morning. Some people concerned about its impact on inflation, of course, but also looking at the structure of oil markets, the fact we're in backwardation. Some focus on the elevated spot prices, others focus on the less elevated futures prices, and can therefore create either bull or bear cases for oil from here. What are you seeing of interest in oil markets?
Yeah, I love that debate about backwardation and the time spread in oil, right? I think, you know, if you look at it historically, whenever oil prices spiked, you definitely see the near term. It's at the near term. It's a shortage of near term supply that is driving the market, right? If you can't get hold of oil now, people get desperate. They pay more and more. And I think, but that usually spreads further along the curve rather than you seeing the rest of the curve dragging the price down. It's fairly rare, I think, to see the back end of the curve pushing prices around, but a lot more research to be done on that. I do think that this feeds very heavily into things like the UK CPI and then into central bank decisions that we get later in the week, because higher oil prices obviously will feed into price levels.
Well, on that point, Eddie, which central bank is most vulnerable, do you think, in terms of adjusting its position based on these higher energy prices? Yeah,
look, the UK is the epicenter of stagflation at the moment, right? And I think so all the data that we get out of the Bank of England or from the UK and then the Bank of England rates decision is going to be absolutely key. But we kind of know that the UK is in trouble, right? We know that the UK is in trouble on that front. We know that it's a difficult, sticky position for them to solve. The Fed, on the other hand, people think that they've got strong growth and that therefore they will probably avoid the stagflation narrative. If we start to see towards the end of the week PMI numbers that come in below expectations in the US at the same time as you see this little bit of resurgence in inflation, then I think the narrative shifts dramatically. So I think the Fed and other central banks probably think that they are getting to the end of their hiking cycles, probably think they're going to stand pat for a little bit. I don't know if the data is going to allow them to do so.
Yeah, really interesting. And so we'll focus on the dots then, Eddie, perhaps from the Fed, and see whether we get an expectation from policymakers that there'll be another hike by the end of the year, and an expectation that 4 of the hikes we've seen will disappear by the end of next year, because that's what seems to have been, that was indicated by the last set of dots that we got. What are you going to be watching for when it comes to that sort of deeper dive into the Fed signalling?
It's very nice to know what the Fed thinks it's going to have to do a year from now, but it's very rare that they actually get to do what they think they are going to. If you plot those dots versus how the market has actually progressed over time, it's very rare that they nail it absolutely on. But it is useful for the markets to know what the Fed thinks it's going to have to do, because they are going to adjust accordingly. So I do think what we've heard from the Fed so far over the last few weeks is, optimism that they're going to achieve this soft landing. I think they might just temper that a little bit. So it's much more about the commentary again for me than about any particular dot point.
Okay.
Thanks, Eddie. Thanks for joining us. Apologies. Delay to Frankfurt. Eddie van der Veld there from the Markets Live team. Let's check on some of the individual stocks then that are on the move. Joe Easton has a briefing. Joe?
So Ocado outperforming in the UK at the moment. We had a 7% jump in revenue quarter on quarter for that company. That's reassured investors after there was some concern around a slowdown in its partnership with Marks and Spencer's, but the retail business maintaining the guidance today, helping that stock move higher. Meanwhile, in the UK, we've also got Kingfisher. This one is dropping. The UK outlook looked okay to me, but there is weakness over in Poland. Now, this is, of course, the owner of B&Q selling power tools. I'll have to drill down into that one a bit later on, but that stock...
Thank you, Joe.
But I had to get that one in. But that one is dropping 5%, so a big decliner today. Meanwhile, Hargreaves Lansdown now, this company continues to benefit from higher interest rates. People have a lot of money held with Hargreaves like we do with banks. They don't have the worries about bad loans like banks do, so they continue to benefit from interest rates rising, and that is what they're showing in their earnings update today. So that one is gaining as well, alongside Ocado, the big 2 movers here in London. In terms of Santander, we had that restructuring last night. Now, that could potentially lead to job cuts. Costs is the big concern around that, but not seeing a boost in that one at the moment. Down 0.3% over in Madrid. And SocGen continues to slump following that sell-off yesterday. A massive drop after their revenue guidance. Disappointed following their strategy update for the French lender. We've got Exane BNP Paribas downgrading that stock today, saying that may not have seen the worst of its decline, so we're seeing weakness there. In terms of the oil stocks, with a lot of focus on crude, up at around $95 a barrel. We're seeing a boost in Shell, Total Energies as well. A lot of these stocks have already risen quite a lot this year, but still gaining on the back of these higher oil prices for those big oil producers today. Then just a quick look at some of the ratings changes. We had Volkswagen in stocks to watch, double upgraded over at Jefferies. They've been underperformed for a long time. That moves higher, along with E.ON, which is upgraded over at SocGen. Just reading that one there, that one up 0.3%. NatWest downgraded at HSBC ahead of the Bank of England's decision on Thursday. Will they continue to see declines given the worries about bad debts there? And finally, Fluidra. Now, this company makes swimming pools over in Spain, one of the best performers in Madrid this year, given continued demand. But those shares are taking a dip this morning, down 2.8%.
Taking a dip. We did miss you, Joe Easton. Welcome back with all the puns. Fantastic stuff. Thank you, Joe Easton, from our equities team with a run-through on some of the stocks on the move this morning. Let's take a look at some of the events we're watching for as well today. This morning, at 10 a.m. UK time, the OECD is going to publish its Global Economic Outlook report, how much adjustments are going to be made around the picture on the health of this global economy. You're going to be speaking to the chief economist as well, Claire Lombardelli, at 11:15 a.m. London time. Also at 10 a.m, the final reading of Euro area CPI for the month of August, as we continue to hear a little bit of pushback from the French, the Spanish and the Italians around that ECB rate increase. Will that colour the picture in terms of the inflation outlook for the Eurozone? Then at 1:30 p.m. UK time, we're going to get the latest reading on Canadian inflation. Economists surveyed by Bloomberg see the year-on-year prints ticking up to 3.8%. And throughout the day, we're going to be following all the conversations and headlines coming out of the United Nations General Assembly meeting in New York City. Anna, really fascinating developments on the geopolitics as well between Canada and India. But of course, our focus does remain on what is happening in terms of the build-up to these central bank decisions. The Fed, of course, tomorrow, but the CPI print out of the UK as well is going to be interesting.
Yeah, Canada in focus also because of that higher oil price and what that does to the Canadian currency, perhaps something to watch. But also with the inflation print later, the UK inflation print really does sound the starting gun, I suppose, on the big set piece events that we're expecting this week. It starts with that data. It ends with some PMI data out of the Eurozone, which I think could be really fascinating on Friday. But before that, we have a whole host of central bank decisions to get through. We've still got, what, 10 out of the 20 of the G20 to report this week.
Yeah, we do. How's the food, by the way, over there in Frankfurt, Anna?
Now, I know you're mentioning this because I've already had about 3 breakfasts. It's delicious. Thank you very much.
Well rewarded, and you deserve those 3 breakfasts. Thank you very much. Anna, of course, coming back to her for the latest on the food situation in Frankfurt. And coming up as well at the EPIM Private Equity Conference in Paris throughout the morning, including that exclusive interview with Blackstone's chairman and CEO, Steve Schwartzman. That is at 10 a.m. UK time. Mark it in your diaries. This is Bloomberg.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has 2 targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. Markets countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is Markets Today. We are 13 minutes should we call it 14 minutes into our European trading day. And the picture for European equity markets looks a little varied. The DAX under a little bit of pressure, but actually not as much as it was. The FTSE 100 just into positive territory. The oil price helping the likes of BP move higher. The oil price, incidentally, at 94.95 on Brent. Now, bond bulls say after a 4-month sell-off, the time is right to get back into treasuries. Alliance Bernstein reckons with the Fed close to signaling its hiking cycle is over, the 10-year yield could head as low as 2.5% next year. Let's see if our next guest has any sympathy with that view. Valentine Hainouz, head of global fixed income strategy within the Amundi Investments Institute. Let's start with that very question then, Valentine. How low do you think that yields get next year? Do you agree with that view that it could be 2.5% on the 10-year? And is that the right question to be asking right now?
2.5, no, but we are seeing the long-term yields around 2.3, 2.2. These could be levels that could be reached next year. Definitely, we are in the camps of the ones who are expecting the U.S. economy to slow down sharply. We are expecting a contraction in economic activity H1 next year and inflation to go back to target and the Fed to cut rates. So that definitely means that we have an opportunity to on the long end of the curve. But we have to be cautious in the short term, because in the short term, the US economy looks to be very, very resilient.
Valentine, that's a really clear call on your views around the US. You get that recession in the first half of the year, you get back to that inflation target of 2% next year, and so then you want to lean into the back end of the curve. Is that the call in terms of the positioning around that view?
Yeah, we expect to move to add a duration position. Now we are more neutral on the US, but at some point we will have some duration position, and we expect a steepening of the US curve. First 530, and then while we will enter a more difficult economic environment, we will move to a steepening to 10.
Okay, and tell us your broader view on the US economy, Valentine, because you talked about how we will see a slowdown, you think, in the first half of next year, inflation coming back to target. But you say that the US economy may not be cooling as expected. And I wonder what you've observed on that front and what it tells you about the pace of slowdown in the US.
I think that the US economy, in the very short term, should remain quite resilient because for 3 factors. The first one is the US labor market that remains quite strong. There is still some strong imbalance between supply and demand that should keep wages under pressure. The second reason is that you still have a very high level of support from the government. The US fiscal deficit is around 6%, so it's something completely unusual in an environment where you have some pressure on inflation and a low level of unemployment. We are seeing now, we're observing a rebound in capex. So this is something unusual, while at the same time you have a jump in interest rates. And the last point, it is the stronger resilience of the US real estate market because of the very low level of inventory and the US household strong balance sheet. So in the very short term, the US economy should remain strong, but this does not mean that at some point, the US economy won't be impacted by this high interest rate environment.
And Valentine, you projected out for us very clearly again into next year. Does that assume the cuts that you see coming through next year, the recession that you see coming through next year, and the current relative resilience of the US economy, does that assume that the Fed is going to have to go again in terms of hikes this year?
I see the probability to have another rate hike is quite high. I think it's really too early to say that the Fed is at the end of the rate hike cycle. Things in the US are going into the right direction. Inflation has moved on from its peak, the US labor market is cooling, but US core inflation is still above 4%. And as I said, there are still strong imbalance between supply and demand on the labor market, and the US economy is resilient. And the Powell was very clear, if growth remains substantially above trends, they will tighten again.
Valentine, can I ask you about the corporate debt side of your remit then, with all of that in mind? Are you concerned when you look out to next year and the slowdown you anticipate, are you concerned around defaults or are you concerned about pricing around corporate debt? What is it that's going to be your focus next year?
Yeah, my focus now is to focus on the impact of this higher real interest rates environment and balance sheet. when I look at US households balance sheet, globally, they are very solid because mortgage were fixed in a very low rate during the pandemic. So definitely no big issue on US households balance sheet. My concern is more on corporate balance sheet and on especially low yield rate for low yield rated debt issuers. For IG, the average debt maturity is around 7 years. So it will take a lot of time for this higher interest rates environment to impact the average cost of IG issuers. But this is not the same story for CCC and low single B that will be more rapidly impacted by this higher interest rates environment, especially in an environment where growth is slowing. So I'm quite cautious on US high low rated issuers.
And Valentin, you explained that caution very well indeed. Do you map that over to Europe as well? We're hearing from Villeroy of the Bank of France saying that 4% is an appropriate level. Where is the debt pain? Where is the potential crunch point in a 4% higher for longer environment across the Eurozone?
Yeah, I think my concern is also in the Eurozone. As Christine Lagarde said, in the US, we are surprised by the low sensitivity of the US economy to the higher rate environment. And Christine Lagarde said that they are surprised by the high level of sensitivity of interest rates of the Eurozone. And this is the same story for the Eurozone. We are seeing already a tightening in credit conditions. We are seeing a jump in interest rates and a strong contraction in the demand for credit, both from companies and from households. So definitely in the Eurozone economy is now very impacted by the tightening of the ECB monetary policy.
Okay, Valentin Hainaut, Head of Global Fixed Income Strategy within Amundi Investment Institute. Thank you very much indeed around the caution for that lower grade debt, corporate debt, and the view that you are going to get that recession stateside in the first half of the year with rate cuts following. Coming up, Santander overhauls its corporate structure. We discuss the changes at Spain's biggest bank and, of course, one of Europe's largest. That is next. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
Welcome back. This is Markets Today, 24 minutes into your European trading day. And European stocks have actually turned positive now. Not by a lot, but they have turned positive after the futures pointing to downside of between 0.2% and 0.3%. You're currently seeing gains of about 0.1%, led by the auto sector, currently up 1.4%. Now, to the banking space now, and Santander is overhauling its corporate structure in a move that may involve job cuts. In a bid to simplify operations and help meet profit goals, Spain's biggest bank is combining individual countries' retail and commercial banking businesses under a new global unit. For more, let's bring in Bloomberg's global finance managing editor, Tom Metcalf. Tom, what does the revamp mean for Santander then?
Yeah, it's a really interesting sort of reporting shift. So basically what they're doing is just trying to make it as clear as possible, for example, retail and commercial, how it operates across the globe. So previously it was very much like a country-by-country basis, which, the sense was some investors got frustrated by that. It was a bit hard to see the big picture. So what Santander say they're doing, they're implementing this, and effectively what it will help people do is get a better sense of how those operations are working globally and a better reflection, I guess, of the ground-to-ground reality.
Okay, so that's what's happening at Santander. And does this follow a trend then, Tom? Have we seen similar things from Citi, for example? What parallels can we draw with other banks?
Yeah, I think the Citigroup comparison is an apt one. So obviously there we saw Jane Fraser do something similar. They kind of broken out, a bit like Santander, the business into 5 units. And, for me, perhaps the most interesting parallel there is perhaps what it says about the various CEOs. So Jane Fraser, it was widely seen as her putting her stamp on the bank, making sure it was kind of reflecting her strategy for the firm going forward. And obviously at Santander, you've got a relatively new CEO there as well, Hector Grisi. And again, it's a move perhaps to sort of reflect, this is the strategy we have and how we're implementing it going forward.
And Tom, briefly, Morgan Stanley also in the news. They're being sued by 2 PE firms. What are the details here? How potentially significant is this for Morgan Stanley?
Yeah, I mean, it's a really interesting case. I don't know how significant it is, but basically 2 private equity firms who assume Morgan Stanley for $750 million and basically saying we weren't sort of informed fully about what the loan was restructuring for. And it was a loan in relation to a high-speed rail between Las Vegas and Los Angeles.
A luxury rail.
Exactly. So extraordinary story. I think probably one of those court cases that will be of interest, but won't be materially significant for Morgan Stanley.
And Morgan Stanley saying that the claims have no merit. Thanks so much to Tom for the update. Bloomberg's finance managing editor, for EMEA, Tom Metcalf. Coming up, we'll be back to one of the top stories of the day, which has to be around oil. Brent crude has topped $95 a barrel this morning for the first time since November. We discuss what is behind the rally and what kind of volatility and pricing we should expect. We heard from the Chevron CEO. He sees $100 ahead. This is Bloomberg.
MasterCard introduced PayPass, its first contactless payment system, in 2002, but the technology took some time to gain traction.
I would say we first invested in this many years ago. The adoption rate on this in the early part, even in markets like the UK, Canada, Australia, was fairly slow in the early part. The inflection point of when it really started to hit its stride was when it was used in the transit vertical. So what we figured is, let's get all the transit systems around the globe enabled for contactless technology. That will create muscle memory for the consumer who will like the experience in transit and will use it elsewhere.
How do you judge the revenue proposition for MasterCard with an innovation like that and the adoption and the pace of it?
Look, I mean, for us, we're agnostic as to whether somebody's using the chip technology or the contactless technology or, using the mag stripe, which was the old way of doing business. we earn revenues which are quite similar across both of those. The revenue potential and upside for us comes from the fact that now more spend is being done on card-based forms of payment than was being done in the past. So we're converting that cash over to electronic forms of payment, which is where the incremental revenue comes from.
If contactless payments is the current revolution sweeping the payments industry, what's the next one?
I think pay with your smile. So, biometrics.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
This is Markets Today. We're 30 minutes into the European trading day. Here are your top stories. Brent crude hits $95 a barrel for the first time since November. Chevron CEO Mike Wirth says oil could top 100.
Sure looks like it. We're certainly moving in that direction. The momentum, supply is tightening. Inventories are drawing. These things happen gradually. You can see it building.
European stocks struggle for direction ahead of the Fed's Tuesday meeting. It's the first of a barrage of rate decisions from around the world. Plus, Santander overhauls its corporate structure. Job cuts could be on the way as the bank's new CEO looks to simplify operations. Tom?
Yeah, there's been a very modest uplift for Santander on the back of that news. We continue to follow that corporate story. Across your benchmark, you're flat, but the futures had pointed lower by around 0.2%. So there's been a very modest turnaround in sentiment. Of course, still waiting, many an investor, for the data that comes through from the UK, tomorrow's CPI, of course, inflation print, but also the Fed, no doubt. The Fed, the dot plot revisions that may come through, and of course, following that, the BOE and then the Bank of Japan early Friday. Across the benchmark then, the European benchmark is flat. The DAX is pointing lower by about 17 points, down about 0.1%, despite the fact the auto sector is getting a lift this morning. The FTSE 100 at 7,661, just gaining 0.1%, and energy is certainly a factor there. Talking of which, let's break it down into sector components. I talk about autos because you've seen some upgrades in terms of what's come through for Volkswagen, and that is leading to some upside for the auto sector. Again, let's change the board so we can reflect on that. And energy, as we think about what $95 a barrel means for these central banks, whether Ven Ram from our MLive team is right, that the rates markets are being overly complacent in terms of dismissing, looking through higher energy costs and what that's going to mean for top-line inflation and these central banks. Basic resources currently up by 0.4%. There's energy then standing out with gains of 0.5%. On the downside, the biggest losses coming through for the tech sector here in Europe, currently down 0.4%. Financial services also performing relatively well in the session today, adding about 0.6%. Autos, there's the standout in terms of your upside across your sectors. Jefferies upgrading Volkswagen, and that's lifting this sector gains of 1%. Anada.
Okay, so that's the picture across equity markets, and the oil price is being felt to some degree. Chevron CEO Mike Wirth says oil prices may soon reach the $100 mark, but he told Bloomberg he's confident that the global economy can withstand such a price spike.
Sure looks like it. We're certainly moving in that direction. The momentum, supply is tightening. Inventories are drawing. These things happen gradually. You can see it building. And so I think the trends would suggest that we're certainly on our way. We're getting close.
Mike, good morning. It's Guy in London. What impact do you think $100 a barrel will have on the U.S. economy? What impact will it have on the global economy?
Well, certainly those are higher prices than we tend to see out over the long term, and so I think it will have some effect on the economy. But we've had relatively higher oil prices here now for most of this year, and certainly all of last year. The recession that everyone's been talking about hasn't arrived, and so I think the underlying drivers of the economy in the U.S. and frankly globally remain pretty healthy. So I think it's a drag on the economy, but one that thus far I think the economy's been able to tolerate.
Have you adjusted your price deck? Meaning, that's my question, being like, are these higher prices sustainable for the long term?
Yeah, we take a very long-term view on supply, demand, policy, technology. We haven't changed our long-term price, but we really don't change that very often, and not in response to what our short-term. And we've been in a volatile market really going back to the pandemic when things came down, the recovery when it was high, the war. So this has been a period of time where prices have been unpredictable and volatile, and not what you would call mid-cycle.
Mike, if I worked for you, if I worked for Mike Wirth and I worked for Chevron, would this be my cue to say, Mike, can I have a pay rise, please?
Well, we're certainly seeing, I think you're making reference to what's going on in different parts of the world. We're seeing organized labor, in many different industries now, kind of assertively step forward and say, look, we want to be compensated. We see the inflation in the economy, and we've seen companies recover. We've had a very strong pay program last year for our employees. We try to stay very competitive, and I would expect we'll continue to do so.
That is Guy's way of getting into the strike action that's happening in Australia with Gorgon and Wheatstone. So far, cargoes have not yet been impacted. You're using some non-union workers, right? Is there a point where that would change?
Well, we certainly hope that what we'll see is a negotiated agreement. Others in Australia have reached agreement with these unions. We've been at the table bargaining in good faith.
Chevron CEO Mike Wirth speaking to Bloomberg's Guy Johnson and Alex Steele. So oil has rallied to a 10-month high then as the market shows fresh signs of tightness driven by those OPEC plus supply cuts predominantly from Russia, of course, and Saudi Arabia. Brent crude topped $95 a barrel for the first time since November. So let's bring in, for more context, Bloomberg senior energy reporter Stephen Stupczynski. Stephen, let's put you on the spot. Do we get to $100 a barrel, and do we get it in the next few weeks?
Yeah, I'm not a betting man, but there is a much the sector is bullish, right? There's this bullish momentum that has swept across oil, and when you look at different oil benchmarks, not the Brent benchmark, but other diesel-rich benchmarks where there is a real concerted effort to buy up diesel and refine diesel. They're above $100 right now. So is Brent oil going to hit that? As long as we keep seeing positive data out of the United States, out of China, as long as OPEC Plus keeps these cuts in place. And if we do get that deficit, OPEC did say last week that there will be over 3 million barrels a day deficit for fourth quarter. That means that there will not be enough supply to meet demand. That's going to eat away at inventories. If we start to see the inventories continue to fall, all of that is going to point to $100 barrels of oil for Brent.
Okay. And Stephen, there's the demand, but this has been very much driven by supply, we're told. And with that in mind, you mentioned OPEC Plus and what they're planning. I know that the Saudi energy minister has been in Calgary, I think it is, in Canada, talking about energy markets and giving very few clues that they're changing their minds at all about supply discipline. What did you take away from his comments?
Yeah, I don't think they're going to be changing their cut regime. Just September 5th, they, along with Russia, said that they're going to extend their 1 million barrel a day cut through the end of the year. I think Saudi Arabia, while they say this is all part of an effort to balance the market, they have been looking to take, a lot of that fluff, a lot of that froth out of the market. And they don't say that there's a price target, but $100 barrel of oil doesn't hurt them. So that's definitely something that would benefit them, benefit their budget. But with everything set right now, I think it would be quite a big change of pace if they were to come back and say, hey, actually, we're going to add those barrels back before the end of the year. I think the big question is, what are they going to do from January? Are they going to add barrels back? Are they going to stop this cut? Or will they extend things into next year? And how will that affect the market and the tightness going into 2024?
Stephen, thanks very much. Bloomberg senior energy reporter Stephen Stapczynski with the latest on the oil markets as we watch Brent go above 95, actually at 94.80, and as we focus on other measures of the oil market also moving higher, Stephen suggests. Coming up on the program, he helps run a global private equity firm with more than $140 billion in assets under management. We'll be hearing from the Partners Group chairman, Stefan Meister. That conversation is next. Don't miss that interview coming to us from the EPEM Private Equity Conference in Paris. Danny Berger on the ground for us with that conversation. This is Bloomberg.
Watching and says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority.
Welcome back. This is Markets Today. We are 41, almost 42 minutes into the European trading day. European stocks have turned positive, gaining just over 0.1%, with autos leading the charge, followed by real estate and energy. Let's get back to the central bank conversation, though. Of course, meeting around the world this week. The impact, of course, what is the impact on recent inflation, the rampant inflation, the steep hiking cycle, and what has that impact been on private equity? Looking for some insight is Bloomberg's Danny Berger, who's at the EPEM Private Equity Conference in Paris, standing by with another really fascinating guest. Danny.
Tom, thank you so much. That's right. I'm here with the Partners Group Executive Chairman and Partner. That's, of course, Stefan Meister. Stefan, thank you so much for joining.
Thanks for having me,
Danny. Appreciate your time this morning. Look, Tom kind of framed the conversation for us. Big week for central banks. We had an ECB hike last week. We got a Fed this week, among others. It's a serious reconsideration of leverage and risk. Have you had to reconsider risk and return in your portfolios?
Look, I think everybody has to. And there's more than just the rate side of things. You know, we're at the beginning of the biggest ever recalibration of the economy that we ever had in history at an unprecedented rate of speed. You know, it's the macro side of things with rates, it's the geopolitical dynamics, it's certainly a new transformation of the economy driven by technology and societal changes. So there's a lot of things happening at the same time. I would tell you, though, that I think the focus is maybe nearly a little bit too big on the macro side of things and maybe geopolitical side of things. I think there's a chance that what we see as the change of the economy next 10 years, the transformation by AI and other technologies, that is actually the big deal to deal with. So in terms of risk assessment, we have tried to make our homework on rates and inflation many years back. I think we're in good shape. The big focus is really how the economy is going to transform in the next 10 years.
Yeah, that's so interesting, and it breaks my heart because I love talking about macro here on Bloomberg Stefan. Okay, so in terms of the big transformations, because a lot of people have their eye on the same thing, it's AI, which Bank of America have called a baby bubble. It's changes in healthcare. Where are there still opportunities? Because there is a lot of money chasing after a lot of these same trends.
So let me first tell you that I think the focus on AI is maybe a little bit masked by the accessibility of OpenAI, ChatGPT, which has maybe given a certain way of looking at AI. I think we need to think very much bigger about AI. Go back 25 years, it was the accessibility of internet communication, data management, and computation power that has led to the digitization of the economy in the last 25 years. So AI and related technologies, I think in a very similar way, will completely change the way we work in service business, industrial manufacturing, biologics, creation of maybe new protein, medication, things like that. So it's a much bigger scale thing. Where the opportunities, I think you have to look really through the different value chains or ecosystems. There is a vast number of ecosystems that have fundamentally changed. You talk about healthcare. If you, for instance, look at the change of the profit pool distribution from traditional medical applications, so-called small molecules, chemical products essentially, to biologics, to therapies and all of that, that has come with a complete redefinition of supply chains. The new supply chains, new businesses established in trials, in co-research, co-manufacturing. So this is usually where we see these opportunities, by getting into these value chains or ecosystems and see how the bigger change actually has an effect or impact in these ecosystems.
How do you pursue those opportunities? Because we're in a moment where deal flow on the private equity side has been extremely slow. So are you looking at these opportunities from more of a debt side? How do you gear Partners Group towards pursuing those?
So half of our business is corporate equity. That's about $75 billion. So there is certainly a big focus on the actual equity side of things. We have also lending business of about $30 billion next to that. I think the fact that we have maybe seen fewer transactions than maybe 2 years ago is very plausible, right? I mean, with this decalibration that we talked about, you expect people to pause a little bit and figure out where valuations are. I would tell you that our teams are as busy as they've ever been in looking at these new opportunities. Their pipelines are really big for exits, but also for new transactions. So I think that will just be a little bit of a normalization needed in the next 6-9 months, and you'll see a lot of these investment opportunities. So I think regular investment activities will pick up relatively quickly.
Does it get back to kind of the boom times of 2021, or is that just an outlier?
I think so. But look, let's keep maybe 2009 through 12 in mind. These things take a little bit of time. We have not seen much buyout activity 9 and 10, 11, 12. We saw some of these equity infusion transactions. I don't know whether exactly that's the way this will develop next few quarters, but I do think there's an absolute good chance that we'll see record level of transactions again in a few quarters' time and actually exceeding that.
Stefan, I want to talk about the white paper you wrote in April. Before, I was joking with you that it's very rare we get a chairman who writes such an extensive white paper. Look, this got a lot of headlines because you essentially argued that the new center of capitalism, it's no longer public markets, it's private markets. The money flows tell us that too. How does your responsibility change? As an exec chair of one of the largest private capital firms, what does it mean for you to be the new steward of capitalism?
Look, I think we have been quite early on in telling our LPs and our investment teams, when we run businesses, I mean, we can run them with a very clear focus on returns, but it cannot be that we run businesses where employees are less happy than in public market companies. So I would tell you that one responsibility is, as we look for the financial returns, we look also for returns for stakeholders. We introduced our stakeholder benefits program in end of 19. That was about a commitment that we made to reinvest up to 10% of earnings growth in financial participation, in development plans, in healthcare for employees, things like that. And I know a lot of other groups have followed with similar initiatives. So I think that's really the way I think we'll be measured over time with that role as stewards of the industry, not just in terms of financial returns, but also whether employees like to work for the companies that we own.
Well, there's another side to this too, in that in public markets, my parents who are not in finance can go and they can buy any company that's listed publicly. I, of course, can. I have some journalistic things there that I'm not allowed to. But look, most people can do that. A private market, I mean, my parents couldn't get in the Partners Group Fund, for example. So what does that change for you? Do you need to be more retail investor oriented in this new world?
Absolutely, Danny. I mean, look, there is a huge thing ahead of us. People label it democratization of private markets, which essentially is exactly about giving that access to individuals to make private market investing. That requires new products that look a little bit more like mutual funds. Some of these products are actually existing already today. We run some of these for about 20 years now. And I think it's now about lowering maybe the minimum entry hurdles for investors. The reason why I think that's very fundamental, and maybe it's a bit underappreciated by people, is that the size of that part of the industry is amazing. We talk about $160 trillion invested maybe about 1% or so. If they go up, let's say, close to 10%, you talk about a size of more than $10 trillion. That's the size of the entire private market industry today. So if that happens, and new entrants come to the market, money managers, traditional wealth managers, and so all of that, that will change the industry quite a bit.
Well, Stefan, I know you're giving a speech here at EPEM soon about some of these topics, so I won't front run you too much. We really appreciate your time. Thank you so much for joining.
Thank you so much for having me, Danny.
And Anna, with that, I'll bring it back to you. That's, of course, Stefan Meister, the executive chair and a partner at Partners Group.
Danny, thanks very much. We're both Danny Berger with the Partners Group chairman at the EPEM conference then in Paris, talking about the private nature of the future of capitalism. Stick around because we'll be bringing you more from EPEM throughout this morning, including an exclusive interview with the Blackstone chairman. That is at 10 a.m. UK time. CEO of the business, Steve Schwartzman, joins Danny on the ground. Coming up, companies are making big bets amid rising geopolitical tensions. Today's Big Take looks at how foreign direct investment is being shaped by politics. That's next. This is Bloomberg.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
This is Markets Today. We are 53 minutes into your European trading day. Very slim gains of about 0.1% across European equities. A little bit of strength coming through for the auto sector, up 1%. And the futures in the US, S&P E-minis, just pointing to gains of about 0.1%. Now, as world leaders gather again at the United Nations, a new Bloomberg economics analysis of trade and greenfield FDI data shows how a geopolitical diversion is starting to shape corporate investment. Let's dig into the big take then with Maeva Cousin. She's senior euro area economist at Bloomberg Economics. Maeva, we have geopolitics then becoming increasingly important for business and economic decisions. We know, of course, there's a focus on China and potential decoupling there. There's a focus, of course, on the risks around Russia, given their invasion of Ukraine. How is this changing business and investing decisions?
Hi, Dom. So yes, if you look at earnings transcripts or company communication from the last year, you will see that geopolitics has been mentioned 3 times more often than just 2 years ago. So clearly it's on the forefront, it's on the mind of business leaders as they decide where to invest, because they look at risk, they look at expected returns, they look at risk, and they make their decisions. So what we've done is that we've looked at investment flows, global investment flows published by the United Nations from a macro perspective. And indeed, when you look at investment flows, you can see that those business leaders are walking the talk. You can see that geopolitics are starting to affect the way investment flows are redirected across the world.
Okay, really interesting read, this big take on the way that you can look at votes at the United Nations and then find evidence of increasing concern about them in the FDI flows. So as investment then, Maeva, starts to shift along these geopolitical lines, who are the winners and losers, and how porous is the border between these two rival camps?
So yes, as you said, we use these UN votes to decide. So basically, on one hand, we have the countries that decided to condemn Russia's invasion of Ukraine. On the other hand, the countries that decided not to condemn it. Countries that decided to condemn, that's mostly, of course, US, Europe, most advanced economies. It's 70% of global GDP. Those who didn't condemn, so either they voted against the resolution or they abstained from voting. It is, of course, Russia, also China and India and Vietnam. That's the key economies. And what we've seen is that the flows of investment that went to those countries that decided not to condemn Russia's invasion, they were only about 15% of global flows in 2021-22. They used to be about 30%, so twice as much. So there are signs indeed that global investment flows are not going as much as before to those countries that didn't condemn the invasion. And among them, Russia and China looks to us as the biggest losers.
Maeva, thank you very much. Thanks for bringing us the really interesting research. Maeva Cousin, senior euro area economist at Bloomberg Economics. NI Big Take on the Bloomberg terminal, or you can find it on the Bloomberg website, bloomberg.com as well. And Tom, a really interesting look here, because China is front and center to this, isn't it? Even if the particular friction that the team were looking at was actually around Russia's invasion of Ukraine, Chinese leadership of that rival bloc really at the heart of this.
And on a day when we reflect on the fact that foreign outflows from China hitting the highest level since the end of 2015, about 50 billion just in a single month. So that points to the here and now in terms of the repositioning. Anna.
That is it for Markets Today. You can get insights from us and the team on the front page of the Bloomberg UK website, of course. This is Bloomberg.
2018, the IPCC did what was called the 1.5 report. What was the difference between what a 2-degree world looked like and what a 1.5-degree world? And the catastrophe to the planet between those two poles led everybody to conclude that actually the job is bigger. We have to go to net zero. And that's a transformation of the global economy on the size and scale that's never occurred in human history. So that's a kind of daunting task, but it's full, I think, also of challenge, opportunity, the chance for innovation, and the chance to have the private sector play a fundamental role in making that change happen.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London, in for Francine Lacqua. Here's what's coming up on today's program. Brent crude hitting $95 a barrel for the first time since November. Chevron CEO says 100 is in sight. And stocks wavering as traders brace for a hawkish tone from major central banks. The Federal Reserve kicking off its 2-day meeting starting today. Plus, Santander revamps its structure, a move that could lead to job cuts as the bank's new CEO looks to simplify its operations. Now let's take a quick look at how European markets are trading here, because you are seeing a little bit of a mixed picture. Remember, as we talk about central banks broadly, you are going to see a little bit of a tone of caution. And I think that's what's interesting here. As we see, yes, green on the screen, but not that much. Remember, volume is going to be a little bit lower. Again, everyone kind of on the back foot rather than these massive positioning you're going to see going into the Fed tomorrow, the BOE, and then, of course, the BOJ, not to mention the slew of central banks around the world. Right now, your outperformer is actually in the FTSE MIB right here. That's where you're seeing Italy outperformed by 0.4%. The underperformer is going to be in some of those smaller markets as well, but I think the UK is where we want to focus in on, because that's where you're seeing only gains of 0.2%. Yesterday, remember, the turnaround was that the FTSE 100 actually underperformed the broader continent, so it's interesting to see the dynamics still in play this morning. I want to go abroad, though, across the Atlantic and talk about the United States, because the S&P 500 is really going to be in focus. Take a look at this one-year chart. It feels like a one-way direction, really a one-way road, if you will, starting to see a little bit of that momentum come off. And that's going to be significant as we talk about what are the lags that the Federal Reserve perhaps isn't talking about. And that's significant, again, simply because we are talking about the idea that a lag could start to take in place later. Economic data could then deteriorate, and that could weigh on the S&P 500. It feels like that sentiment already showing up, which is why that peak in July is already coming off. Let's go, again, across the Pacific, a journey around the world, if you will, and talk about the other major decision, the game changer, which could be this week, and that, of course, is the BOJ. The yen swaps is interesting here, because if you take a look at the FX story and the bond yield, markets are already pricing in that this Friday is going to be one for the history books. Perhaps Governor Ueda is actually going to be talking about maybe getting off that negative interest rate policy. Now, it does feel a little mind-boggling to perhaps get there, but that is not stopping those FX traders and bond traders from pricing that in. Do they deliver? Do they finally actually deliver on that shorting JGB trade, which is apparently something that people are still betting on? I want to end it here with actually something the BOJ, the Federal Reserve, and central banks around the world are going to be talking about, and that is Brent crude. Take a look at this 5-year chart. Now, over 5 years, It doesn't really look like that much has happened, but I promise you it has. Remember when 2019 we were talking about those tariffs, then simply China-U.S. tensions, we go down into the pandemic, we recover massive demand all the way into 2022, and that's when we start talking about the supply crunches that you were seeing come out of OPEC and, of course, the deteriorating Chinese economy. Now, it's less a story of demand, more a story of supply. Those tighter markets you were seeing in physical crude, that's where you're seeing the pain, pushing the market higher. Once again, do we hit $100 a barrel? What does that do to the U.S., especially, by the way, going into a presidential election next year? Now, that's going to be significant, and that's where I want to start such a crucial markets conversation this morning. Joining us now to dive into it is Maya Bandari, BNP Paribas Asset Management's Global Head of Multi-Asset. She joins me right here on set. Thank you, as always. You picked a great day to join us because commodities are all the rage, and 2021, it was a really easy trade. You buy your regular portfolio, you get a basket of commodities, you throw it all into a bundle, and boom, you're hedged. Does that trade work again?
As I think you just reflected, commodities and particularly oil have moved quite a long way in recent weeks. Now, you're right, commodities, you could almost shut your eyes last year, and it didn't matter which commodity you'd invested in. It gave you a positive return in a year where every other asset class gave you negative returns. That's, of course, not the picture this year, although commodities certainly have risen. To us, it's really a supply-led story, and frankly, one we've benefited from because we've been long of commodities in BNP PAM asset allocation portfolios for much of this year. And that's, if you will, helped us in a world where I guess you've had a lot of narrative volatility, if you like.
I love that you called it that, a narrative volatility, though, and that's really interesting because if you talk about what's actually pulling the market, I'm going to nerd out for a second. Bear with me, Maya. We'll come back to the markets, but the geopol is really interesting here simply because we talk about the Saudis really driving these OPEC decisions, even Vladimir Putin to some extent becoming a part of it. So to really price in the oil market and inflation broadly, if it indeed is led by commodities, you kind of have to be in the mind of the decision makers in Saudi Arabia. From an asset management perspective, how do you price in that volatility? How do you hedge it when really it's kind of hard to predict what's going to happen next?
Well, I would, as an asset allocator, I'd sort of look at commodities in a broader portfolio construction context. So I'd be thinking about commodities in context of equities, various flavors of fixed income, currencies, bonds, and so on and so forth. And so, as we reflected earlier on, I think commodities have actually given you a little bit of diversification this year. Certainly gave you a whole lot of diversification last year. Now, I think when I think about commodities, say earlier this year, in another period of narrative volatility, commodities were really priced quite bearishly, whereas equities were rallying quite hard earlier in the year. Commodities were quite soft and really seemed to be much more in the recession sort of narrative than the overheating or Goldilocks narrative. Today, of course, commodities have risen, and oil in particular has risen quite nicely. But I think and particularly this week, I think what's really interesting to probe as well is how higher commodity prices alter that Goldilocks narrative that has been all pervasive in markets, and we see that when we look at cyclicals, we see that when we look at bond yields, and to our minds, it really impacts, if you will, more the growth side of the Goldilocks equation than the inflation side of things over the long term, precisely for the reason that you suggest. This is really a supply-led story to our minds.
You said it beautifully, because one of my favorite charts is actually if you overlay oil and bond yields, they're not tracking each other the way they have for the last 5 years or so, which to your point illustrates that perhaps this isn't a commodity-led market. This is really the focus is back on growth. So let's put our central banking hats, if you will. Tomorrow's the Federal Reserve decision, BOE on Thursday, BOJ on Friday, not to mention a slew of others around the world in case you really were missing the central bank's action. If you're Chair Powell, what do you do right now?
Well, I mean, I guess if we start off with where the ECB left things last week, I guess we had, to our minds, a dovish and final hike from the ECB. Look, I mean, I think our expectations, like I think most people's expectations for the Fed this week is it stays on hold, leaves the door open for a November hike, but in our view is very unlikely to use that option, quite simply because we see, the 525 beats of hike hikes that have already are coming through the U.S. economy, starting to belatedly impact growth, impact the labor market. And so, I think, as I said, I think the downside risks to growth, to our minds, are a bit more pronounced than the upside risk to inflation right here and right now.
Well, I'm glad you said that. 525 basis points of hikes echoing through the markets. I mean, they're calling it a hawkish pause is what we're going to hear, which, again, I still don't know what that means because that could be interpreted a million different ways. Talk to us a little bit about the impact on the equity markets here. We saw a taste of this, I want to say, from the ECB and the ripple effects throughout Europe, and then the pushback, I should say, from the fiscal governments across the continent. But in the U.S., if you were coming off a really horrible year, by the way, in 2022 for the equity market, and you were talking about this delayed or this lag coming from these 525 basis points that you just talked about that hasn't quite hit the economy yet, do you then see, and I'm kind of just thinking out loud here, do you then see the economic data deteriorating and by extension, the stock market deteriorating? Or is it all priced in from 2022?
So I'd say no, it isn't all priced in from 2022, but I'd say more broadly, I'd boil down equity market returns into cash flows and discount rates, right? Those are the two drivers, and I'd say today, I think both are in the wrong place, if you will. So I think certainly on the earnings side of things in the U.S. Earnings expectations have actually increased recently, and so for the S&P 500, we're looking for 12% earnings growth next year, 11.5% the year after, high single digits in Europe. And none of that, to our minds, is consistent with that picture of weakening economic activity. I mean, let's not forget, in times of weaker economic growth, as we are starting to see, normally earnings expectations fall by 10, 15%. They certainly don't rise by that sort of magnitude.
It's a really tricky situation. I keep saying this over and over again. You could not pay me to be Chair Powell right now, or frankly, any leader of a central bank. Maya Bhandari, we thank you as always. She joins us, of course, from BNP Paribas, Global Head of Multi-Asset Strategy. We thank you as always. Now, coming up, our exclusive interview with the Global Head of AXA IM's Alternative Business Unit. Imagine nearly $200 billion worth of assets. We're live in Paris at the EPEM conference. Stick with us. This is Bloomberg.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has two targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries. How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Welcome back. This is The Pulse. I'm Kriti Gupta filling in for Francine Lacqua. As central banks around the world meet this week, What impact has rampant inflation and the pretty steep hiking cycle had on private equity? Bloomberg's Danny Berger, who's at the EPAM Private Equity Conference in Paris, standing by with a guest. Danny.
Critty, thank you so much. That's right. I'm here in Paris at EPAM. Pleased to say I'm joined now by Isabel Seymama, who, of course, is the global head of AXA IM Alternatives. Isabel, thank you so much for joining. A pleasure to speak with you today.
Thank you for the invite. Good morning.
Look, AXA IM, the alternatives business, it has a lot under its umbrella. You have real estate, you have debt, you have infrastructure, you have private equity. In this era of higher rates of economic concern, what is the most popular? What is the most in demand of your products?
Definitely those who offer good protection, notably against inflation, against interest rates. So I will mention two. Everything that is private debt, because generally private debt is indexed on floating rates, and also infrastructure because of the underlying. It means that cost of funding have increased, that's for sure. That's why there is such a traction around everything that is private debt. And that also benefits from the banking disintermediation. So there is different trends that are supporting private debt. When you are looking at the other asset classes, notably you've mentioned private equity, but also real estate, of course, there is some pressure and valuation pressure.
Right, and of course your largest chunk of offering is real estate. I mean, there's been plenty of concerns around real estate. When it comes to commercial real estate, and as work from home still lingers, how are you evaluating risk right now in the portfolio?
But it's for sure that the office market is under pressure, probably more in the US than in Europe because of this work from home and the oversupply. But for us, real estate is a very large range of underlying assets. Office only represents less than 30% of the real estate portfolio we manage. But we have invested notably in residential, in logistics, and a lot of alternative asset classes within real estate that are performing very well. So, of course, the office market is what is on the headlines. It's generally the big bulk of allocation for a lot of investors, but we've managed to diversify and to reduce the quantum of offices.
Do you buy this thesis, though, of a doom loop, of an office real estate? You have more defaults, it puts more pressure on central banks, and the cycle kind of goes on and on. Is that a realistic outcome?
I think even when you look at the office market, that is for sure under pressure, and there is refinancing that are at risk under pressure because of too high leverage. But nevertheless, we have also to, when we look at the office market, to look at the differences between what we will call the stranded assets and the prime asset. If you look at here in Paris, the prime asset are reaching level of rents that at record high, very high level of rents, because there is a real scarcity of the best assets. So even within real estate and within the office segment, there is really a lot of different things.
And when it comes to real estate, one investment that really caught my eye, it was just earlier this year, just in the summer. You bought a French film studio and production space. I know it produced films like Marie Antoinette, one of the Hunger Games. What is the thesis of buying a film studio space? It's such an interesting one.
But the thesis is very simple. It's you have such demand for content from all the big Netflix and so on that this sector is benefiting from a lot of demand, so good cash flow, good potential growth. For me, it's exactly the same thesis that we had when we have invested in data centers, when we have invested in life science building or in student accommodations. All those asset class that benefit from strong growth because of the underlying demand. And so, yes, the objective, of course, studios are more glamorous, for sure. But yeah, the thesis is really about growth and potential.
I was going to say, when do we see the AXA IM documentary coming out? You give them a little wink, wink, nudge, nudge. How does the Hollywood actors strike play into that? Because there might potentially be this period without content because of that. Does that change anything for you?
No, because yes, here we are playing in France with a French studio, so we are not impacted by what's happening in Hollywood, and there's still a lot of demand from, it's not just the big US platform, but also the European players, and there is the new demand that is coming thanks to the internet, but also more and more production is made within studio instead of outside. The film, they want to go in studio because it's cheaper, it's easier, you don't have to deal with the weather, so it's far more efficient. So you have a transfer from the historical production that is going more and more in the studio and more demand. So
do you grow that then? Do you want to do more bolt-on acquisitions? How prime is this space for private capital?
I think the way we are looking at it, it's exactly what we have done with other platforms, is we leverage on our development capabilities, on our capability also to manage private equity and teams and to operate those ecosystems. So the idea is to grow and to aggregate, maybe with other acquisition or developing and refurbishing and adding capex to maintain and to upgrade the quality of those studios. So it's a mix of growing organically and inorganically.
Now, Isabel, before I let you go, AXA has an interesting structure because, of course, you're born out of a specific company that's not necessarily private capital. We've seen that happening more, be it insurance, be it with big funds. PGIM, for example, comes to mind. We've seen more people, even banks, adding on more private credit and private capital in general. What does the competitive environment look like for you right now?
Well, I think with the volume of AUM we manage, close to 200 billion euros, we are the biggest or one of the largest in Europe in an environment that is mainly dominated by American players. So we have this European DNA, and probably the way we play competition is being, I think, very credible in everything we do regarding climate change, decarbonation. Yeah, we are definitely, I think, leading, notably thanks to our real estate platform. Real estate, it's 40% of the green gas emissions. So we had to be ahead on this, and I think that's the way we position ourselves, having very strong convictions and also capabilities on addressing this carbon story.
Well, a good place to end it on a European note here in Paris. Isabel, thank you so much for joining. A pleasure to speak with you.
Thank you very much.
Kriti, that was, of course, Isabel Seymama of AXA IM Alts.
Bloomberg's Danny Berger in Paris there with that exclusive interview. We thank you as always. And still, with more to come from EPEN, an exclusive interview with Blackstone Chairman and CEO Stephen Schwarzman coming up at about 10 a.m. UK time, an interview you do not want to miss. Coming up on this program, we're going to talk about oil a little bit. $100 a barrel on the horizon. Do we get there? More on the outlook next. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Welcome back to The Pulse. I'm Kriti Gupta in for Francine Lockwell. We are getting some headlines here on the internal shakeup within BP, British Petroleum. Kate Thompson named the interim CFO there. She, of course, has had several pretty senior financial roles, including being group treasurer and the head of group tax, that according to a press release coming out from British Petroleum. We, of course, will keep an eye on that and give you more developments as we get them. For now, though, I want to broaden out a little bit, get a little bit more analysis on the market broadly, and talk about oil getting closer and closer to $100 a barrel, hitting 95 just earlier in today's session. Bloomberg's Will Kennedy, senior executive editor for all of our commodities and energy coverage, joins us right here. Will, $100 on the horizon. Chevron CEO said it himself. How do we get there? Whose court is the ball in?
Well, a lot of people are talking about $100 now, as you say. I think it's a reflection of the fact that clearly we can see that supply is going to be constrained until the end of the year because Saudi Arabia and Russia have said they will keep those cuts in place. Meanwhile, we're seeing a little bit of a pullback in growth from the shale fields in the US, and demand globally, for the time being at least, remains very robust. So we're seeing tension throughout different parts of the oil market. If you look at the price of oil now versus the price of oil in the future, it's showing there's a lot of demand right now. If we look at demand for actual physical barrels rather than the futures prices that we track day to day, that's very strong. And if we look at refining margins reflecting how much stress is being put on the refining system to turn that crude oil into fuels, again, signs that a strong market. So you put all that together, and it's not a surprise that people like Mike Wirth, the Chevron CEO, say that they see $100 on the horizon. How long it takes? Well, you know, that will depend on the day-to-day ups and downs of the market, but clearly a lot of people see it as a possibility as we go into the winter demand season.
A lot to digest. Will Kennedy, I wish we had more time with you. There's so much going on in the oil market right now. If that, of course, the bull case you outlining with the Saudis and essentially this physical tightness that you are seeing in the markets. If there's a bear case to it, too, simply that the demand, the robust demand that Will Kennedy was just talking about, pulls back more substantially. But right now, again, the focus all about supply, as he just pointed out, something we're going to be watching very, very closely. Coming up, we're joined by the chief executive of Entain as Morgan Stanley resumes its overweight recommendation on the UK-based gaming company. That interview next. This is Bloomberg.
watching and says, I want to be Ari Emanuel when I grow up, what should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
This is Bloomberg.
Brent crude hitting $95 a barrel for the first time since November. Chevron CEO saying 100 is in sight. Meanwhile, stocks waver as traders brace for a hawkish tone from central banks around the world. Federal Reserve kicking off its two-day meeting today. Plus, Santander revamps its structure, a move that could lead to job cuts as the bank's new CEO looks to simplify its operations. Good morning and welcome to The Pulse. I'm Kriti Gupta in London, filling in for Francine Lacqua. We'll start there with Santander. Shares flat after Spain's biggest bank revealed an overhaul to its corporate structure in a move that may involve job cuts. Bloomberg senior finance editor Stefania Bianchi is following the story for us. Stefania, what does a revamp actually mean?
Well, as we understand it, what's going to happen is that it's going to combine its individual countries' retail and commercial banking operations, and then rearrange them into 5 units. And this is going to be digital, retail and commercial, payments, wealth management, insurance, and then corporate and investment banking. The idea is really to simplify the business and really drive profitability. So that's the thinking behind what's happening now.
Well, it's really interesting that we're getting all of this banking news all at once, because we had Citi talk about their revamp last week as well. Again, simplifying management, potential job cuts, a lot of the same language being used there. Are there any parallels right now that perhaps we're already seeing?
That's right. As you say, this comes about a week after Jane Fraser announced their own revamp of the bank at Citigroup. Again, Citi is going to have 5 units, similar to Santander. The idea with Citigroup is that she is really looking to drive up the stock price that has been really in the dumps since she joined in 2021. So a little different reason behind the strategy, whereas Santander is looking to drive up profitability. Citigroup is really thinking of the shareholders. But again, this could lead to job cuts, as the measures at Santander could also as well.
I love that you brought up the price-to-book ratio, because whereas Citi is the laggard in the U.S., here it's SocGen, and it's definitely not Santander. Bloomberg Stefania Bianchi all over that story for us. We thank you, as always. I want to go to one of the major calls coming out of the banks this morning. Morgan Stanley resuming its overweight recommendation on gambling group Entain. The company's share price has struggled this year compared to rival Flutter. It comes as Entain, the owner of high-street betting brands such as Ladbrokes, Coral, and BetMGM, is facing ongoing regulatory pressure alongside the rest of the industry. Joining me now, I'm pleased to say, is the chief executive of the company, Jette Nygaard-Andersen. Thank you, as always, for joining us this morning. Let's start with growth prospects. It feels very easy right now to talk about technology broadly, but sports betting in particular in the context of AI. Talk to us about your plans for AI in terms of your growth strategy.
I think AI is going to be a significant opportunity for many industries, and it certainly is for us. So when I think about AI and the opportunities, it's really around personalization. So for us, AI will allow us to target the right customer at the right time with the right bet. And we can fast forward that and think broader around it. Can we use both generative AI as well as conversational AI to really personalize that experience for the customer? And then you can think about automation of the front end, automation of MarTech and CRM and developer productivity. Now, we've been working with both machine learning and AIs for some times now. So both when it comes to our networks operation, that's more on the efficiency side, but also when it comes to player protection. And I think that's really where we set ourselves apart. So we've invested a lot of resources into building our own technology to protect customers that play with us. And that's driven by AI, which means that we can actually roll out a personalized safety net for you as a player. It's real time, it's proactive, and I think for the future, that's the best way to protect customers.
Well, AI, of course, being on the topic of a lot of media companies, it doesn't just come to the gaming sector, it comes to broader Hollywood as well, which brings me to one of the major, perhaps, partnerships that I'm curious if it worries you. Disney partnering with Penn Gaming in particular, their ESPN business. How does that affect you, if at all? Does it inspire you to perhaps partner with a bigger media company? What do you think?
So in the US, we are a top player. We built that business from a standing start just 4 years ago when suddenly the states could legalize sports betting and iGaming. And since then, we've really seen a lot of consolidation in the top. So the top 3 players, and we're among the top 3 players in the US, have been sitting on around 80% of the market share, and that just tells you a little bit about the market. It's very complicated what we do. We are technology and data-driven companies, and we're also entertainment companies. So there's been a lot of consolidation already happening in the market. But listen, competition is not new for us. We see that every single day, and while we have a couple of new players now entering the market, we've also seen 2 free players actually leave the market. It just proves how difficult this is, how much capabilities that you need to have on board, and the scale of operation in order to provide great products for your customers.
Well, you hit on a key issue there. The regulation is really a key point of kind of the growth prospects there that I think you're starting to see take over the world. But on that topic of partnerships, you're already in a partnership with MGM specifically. We know that MGM has already tried to make a bid for your company as well, which has been rejected. DraftKings as well. I think the idea behind the rejections, correct me if I'm wrong, was that perhaps you could grow a little bit more on your own. But if you look at the way the valuations are functioning, you're not there yet. Why do you think that is?
So the stock market this year has been quite lackluster, and we've taken some pain from that. But listen, the growth opportunities in this business is just enormous. But it was also clear when I joined as a CEO that in order for us to capitalize on those growth opportunities going forward, we needed to make some changes to the business. First and foremost, we put a new strategy in place, which is all about growth, so we know exactly where and how we want to grow going forward. But what we also did was we put sustainability at the core of our strategy. And we're quite unique in the industry. We're the only global operator that's taken that step, and that has seen us exit a number of markets. Just this year, we've exited 10 markets. The years before, a number of markets we've exited, and really leaning into sustainability. And for us, that means being a responsible operator. We're only going to operate in regulated markets. We're the only global operators that said we're only going to operate regulated and regulating markets. So there's some pain we're taking from that, but that will flow through the business as these regulatory pressures ease, and we'll lean into our growth opportunities.
You know, it's interesting that you talk about sustainability, and as admirable as that approach is on paper, if you look at it from a market judgment perspective, your main rival Flutter is not having those same pressures. Do you foresee the strategy really encapsulating Flutter or competing more aggressively with them in the long term?
So I think just starting with sustainability, we fundamentally believe that being the most sustainable company in our industry is also going to lead to being the most successful. And why is that? Well, it gives you better quality of earnings, and it also gives you better visibility as you operate in regulated markets.
But under what time frame, might I add?
But it's going on at the moment. And you will see more and more countries actually regulate. So we are almost 100% regulated now. The biggest markets that are implementing new regulations in where we operate is the UK, as you're aware. It's Germany, and Brazil is also coming up. So that's all within this time frame. We have the new white paper out when it comes to the UK. We're having consultations. So you will see that new regulation come into place beginning of next year. That should hopefully create a level playing field for operators. So we are very confident that leaning into being a responsible operator is not only the right thing to do in protecting our customers, but it will also lead to being the most successful in the industry. And then, of course, there's some of the growth markets that we are leaning more into. US is a huge opportunity for us. We're number 1 in iGaming, but we're number 3 in sports betting, and we want to, take market share there. So we've done a number of both investments and changes to our product and our technology, really enable us to take more market share here.
Well, it seems like the next logical step then is to, I IPO to debut on the U.S. markets. Do you think you will, or even BetMGM specifically, especially right now when the IPO market is picking up a little bit of steam?
So for us right now, the opportunity is so big in the U.S. So we, together with our partners, MGM Resorts, we are fully focused on the opportunities that we have in the U.S. So as I said, we have enormous opportunity to grow our market share when it comes to sports betting. We just rolled out a new app. We've acquired a company that will see us have in-house the full suite of specific products on something called single game parlay and derivatives and so forth. So as parents of the company, we're focused on really capitalizing on that opportunity. The company grew 55% the first half of this year. We are on track to deliver revenues in the top end of our guidance.
Let me interrupt you right there, if you don't mind. These sound great, and it's true. The growth prospects in the U.S. are enormous from Entain. It feels like to capitalize on the growth prospects that you're talking about, you need funding to get there. Isn't an IPO the fastest way to get that? Why not IPO?
So the great thing about the partnership that we have with MGM is that both of us have capital to invest in BetMGM, and we're fully focused on maximizing that opportunity. Now, how it will look in the future, that's something that we'll talk about, but for now, the opportunity is there to make sure that we grow the business in the U.S. And by the way, from a standing start 4 years ago, we're on track to becoming profitable in the second half. You don't see many businesses have grown revenues to $2 billion, becoming profitable just in 4 years. So that's really what we're focusing on now.
So you are open, very quickly, you are open to an IPO down the road?
So listen, everything is on the table, but it's not for now. Now we are very focused on making sure that we can make BetMGM the best it can ever be, and by that also come growing its market share.
A pleasure to have you on the show, and hopefully you'll give us your first interview if you do indeed choose to make that step. Jette Nygaard-Andersen, the chief executive over at Entain, joining us right here on Bloomberg Television. We thank you as always. Coming up, we stick with the story in the U.S. The UAW union warning its U.S. car plant that strikes could be expanded on Friday unless there is serious progress in negotiations. We'll bring you the latest next. This is Bloomberg.
The IPCC did what was called the 1.5 report. What was the difference between what a 2-degree world looked like and what a 1.5-degree world? And the catastrophe to the planet between those two poles led everybody to conclude that actually the job is bigger. We have to go to net zero. And that's a transformation of the global economy on the size and scale that's never occurred in human history. So that's a kind of daunting task, but it's full, I think, also of challenge, opportunity, the chance for innovation, and the chance to have the private sector play a fundamental role in making that change happen.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Welcome back to The Pulse. I'm Kriti Gupta. Chevron CEO Mike Wirth says oil prices may soon reach the $100 mark, all thanks to tightening supplies. But he told Bloomberg he's confident that the global economy can withstand such a price spike. Take a listen.
Sure looks like it. We're certainly moving in that direction. The momentum, supply is tightening, inventories are drawing. These things happen gradually. You can see it building, and so I think the trends would suggest that we're certainly on our way. We're getting close.
Mike, good morning. It's Guy in London. What impact do you think $100 a barrel will have on the U.S. economy? What impact will it have on the global economy?
Well, certainly those are higher prices than we tend to see out over the long term, and so I think it will have some effect on the economy. But we've had relatively higher oil prices here now for most of this year and certainly all of last year. The recession that everyone's been talking about hasn't arrived, and so I think the underlying drivers of the economy in the U.S. and frankly globally remain pretty healthy. So I think it's a drag on the economy, but one that thus far I think the economy's been able to tolerate.
Have you adjusted your price deck? Meaning, that's my question, being like, are these higher prices sustainable for the long term?
Yeah, we take a very long-term view on supply, demand, policy, technology. We haven't changed our long-term price, but we really don't change that very often, and not in response to what our short-term. We've been in a volatile market really going back to the pandemic when things came down, the recovery when it was high, the war. So this has been a period of time where prices have been unpredictable and volatile, and not what you would call mid-cycle.
Mike, if I worked for you, if I worked for Mike Wirth and I worked for Chevron, would this be my cue to say, Mike, can I have a pay rise, please?
Well, we're certainly seeing, I think you're making reference to what's going on in different parts of the world. We're seeing organized labor, in many different industries now, kind of assertively step forward and say, look, we want to be compensated. We see the inflation in the economy, and we've seen companies recover. We've had a very strong pay program last year for our employees. We try to stay very competitive, and I would expect we'll continue to do so.
That is Guy's way of getting into the strike action that's happening in Australia with Gorgon and Wheatstone. So far, cargoes have not yet been impacted. You're using some non-union workers, right? Is there a point where that would change?
Well, we certainly hope that what we'll see is a negotiated agreement. Others in Australia have reached agreement with these unions. We've been at the table bargaining in good faith.
Chevron CEO Mike Wirth speaking to Bloomberg's Guy Johnson and Alex Steele there. Let's get the latest on the car worker strike action, at least stateside. United Auto Workers Union says it will expand its strike at the big three automakers at noon this Friday if serious progress is not made on the negotiations. Bloomberg's Oliver Crook joins us now. He's been following the story. Ollie, bring us the latest here. Has any progress actually been made?
Crady, not really. So we're really deadlocked at that 20% figure that Stellantis, Ford, and GM put forward to the United Auto Workers Union, and that was a no-go. We got that yesterday in very plain terms, and what the president is now saying, Sean Fain, that the ball is in their court, and they need to come up with something better, and they need to do it basically before Friday, because, as you mentioned, they're going to expand that strike potentially at noon on Friday if they don't get something substantially better. And remember, less than 10% of this union is currently on strike. That means that you have 150,000 workers that potentially could step out, and that would basically bring the big three to their knees and completely paralyze operations in North America.
It's so striking to me how quickly this is spreading, because really this has been, I think, the third or fourth type of labor story we saw in the U.S. Hollywood, pilots, Teamsters, and now the UAW. Now this is turning into an international story.
Absolutely. Just over the river from Detroit into Canada, Ford has 3 facilities. They've got an assembly plant and 2 engine factories, and the workers there are currently, right now, in negotiations with Ford. Their contracts expired at midnight. They have extended that window of 24 hours for those negotiations, saying that they've gotten a substantive offer from Ford, and so they are considering it now. So maybe there's some progress being made there, but it's all about the same themes, right? It's about wages, it's about pensions, and it's about reassurances around the EV transition, which is really worrying workers, but companies alike. And if they do go on strike, that could impact the V8 engines that go into the Ford F-150s and into the Mustangs.
Well, talk to us about the margins of that, because in theory, it feels like if you do start to see a lot of those cars that you just laid out hit, less supply, more demand equals higher prices. Talk to us about the margins for some of these car makers. Where does the pressure come from?
Yeah, well, the unions are referencing the profitability of these car companies, which have been higher because there have been so much pent-up demand and so much that has had to get worked through. But for these legacy automakers, there are a lot of issues ahead. And when you look at the actual cost of labor per hour on average for the big three versus some others, it's pretty interesting. It's about $66 an hour for the big three. If you look at Tesla, it does not use union labor. On average, that's about $45. If they were to meet all of the demands, the initial demands of the union, that number would go to $136. So really, in the EV transition, competitiveness is right at the center of the conversation, and not just for the U.S. automakers, for Mercedes. We spoke to the CEO, Ola Kalenius, a little bit earlier.
We have always kept lockstep with what's going on in the economy to make sure that we have attractive jobs. So we watch that, and we make adjustments as we go along. But at the same time, we look at, how can we do things better? How can we do work in a smarter way, get leaner, because the cost competition is not going to go anywhere.
And so there you have Mercedes-Benz, a luxury car company with big margins, talking about getting leaner. So this is front and center for every automaker around the planet.
I mean, the fact that how quickly this escalated is really mind-boggling. Bloomberg's Oliver Crook in Berlin following that story for us. We thank you, as always. Let's bring you some of the other stories we're watching from around the world, starting in India. India has rejected allegations made by Canadian Prime Minister Justin Trudeau that its government agents were behind the assassination of a prominent Sikh leader in Canada, calling them absurd. Trudeau said there are credible allegations of India's involvement in the killing of the man outside a temple in British Columbia back in June. Now over to the Middle East, Elon Musk says the Wall Street Journal's report on Tesla and Saudi Arabia holding early talks about an EV factory in the country are, quote, utterly false. The paper had reported Saudi has been trying to attract Tesla with the right to purchase certain metals and minerals needed for its EVs from countries such as the DRC. Now, coming up on the program, companies are making big bets amid rising geopolitical tensions. Today's Big Take looks at just how foreign direct investment is being influenced by politics. That conversation next. This is Bloomberg.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has two targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Welcome back to The Pulse. As world leaders gather at the United Nations, a new Bloomberg economics analysis of trade and greenfield FDI data shows how geopolitical divisions are starting to shape corporate investment. Let's dive into today's big take with Maeva Cousin. She joins us from Zurich as a senior Euro area economist at Bloomberg Economics. Maeva, talk to us a little bit about the role that geopolitics plays here. Give us a case study, perhaps, of where we might find that influence to be more profound.
Hi, Chris. So yes, we've looked at, so if you looked at earnings transcripts, companies' communication, it is clear that geopolitics are playing a bigger and bigger role in their decisions on where to invest, and decisions on how to conduct business. And take, for example, the example of semiconductors at the moment, where companies like TSMC have decided to relocate or actually to build new factories in the US, in Japan, where they used to have mostly factories in Taiwan and mainland China. So that's a concrete example of, especially for very strategic sectors like semiconductors, companies are making decisions on investment that are driven by or take into account geopolitical concerns.
But for a lot of people in a lot of countries, I would argue, it's not really having that much of an effect at all. I mean, we like to look at China as that case example, as you just said. But then you look at, say, Elon Musk, Bill Gates, Jamie Dimon, still making those trips to Asia and beyond. Is there a case here where perhaps geopolitics don't matter?
I think they are starting to matter more. It doesn't mean that that's the only decision, that's the only component of the decision, but they are starting to matter more. So what we've done is that we've looked at macro data of investment flows, especially foreign investment for new projects, for new factories. And what we found is that if you look at countries on one side of the geopolitical divide, and for the geopolitical divide, we've taken this defining event that was Russia's invasion of Ukraine and countries' decision to condemn or not to condemn this invasion at the United Nations. So if you look at countries that did not condemn the invasion of Russia at the United Nations, you can see that they have received fewer investment flows for new projects in 2022. It's particularly true, of course, for Russia. They don't receive any investment in 2022, but it's also the case for China. So it's still porous, the border, but it's changing and it's moving.
It's fascinating to see the kind of interrelatedness, if you will, between business and geopolitics. China, Russia, you name it, you're seeing it really change the way we look at the world. Maeva Cousin, senior Euro area economist over at Bloomberg Economics. Thank you as always. Today's Big Take is on your terminal. Just type in NI Big Take Go. Check it out on Bloomberg.com. Up next, Bloomberg Brief with Danny Berger in Paris, Manus Cranny in New York. This is Bloomberg.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more, but
that's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement
and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with 2 more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
Good morning from our world headquarters in New York. I'm Manus Cranny with Danny Berger in Paris on the road today, speaking to private equity titans. Welcome to Bloomberg Brief. Let's set the agenda. Oil rally gathers pace. Brent touching $95 for the first time since November. Chevron CEO tells Bloomberg, $100, it's in sight. Job cuts could be on the way at Santander. The bank revamps its structure as its new CEO looks to simplify operations. Plus, in this pivotal week for markets, we get the exclusive conversations with 2 private capital titans. Blackstone's CEO and the CEO of Oak Hill Advisors join Danny and I this hour. A little bit of breaking news coming in from the OECD on their latest perspective for the economy. They raised the 2023 world forecast. This is for global growth. For 2024, so they're raising, and they're raising for this year, excuse me, and they are saying 2023 and 2024. My apologies. They are cutting Euro area growth. They're cutting China GDP forecast for 2023 and 2024. It's going to get tough out there. And that is the reflection in the cross-asset web this morning. You've got the oil market, which is dealing with the pressure, you've got the stock market dealing with the pressure of oil and the potential for a hawkish hold. That is what you're really dealing with there. Now, below that stock market, you have an oil colossus, the likes of Halliburton, Conoco, Exxon up 6%. So the musculature of the Brent market and the WTI market is carrying through in one portion. The best performing sector in the S&P 500 this month is the oil sector. And with that in mind, the Brent contract breaks the $95 level for the first time since November. We listened to Prince Abdulaziz bin Salman yesterday saying the jury is still out on Chinese demand. OPEC, we're not trying to jack up prices. We're not going back to the 1980s. And then you have a whole host of voices coming in talking about the ability of $100 oil. That's state of play. Yields are 431 this morning, ticking ever so slightly higher. Let's get to Paris. Danny's got the first exclusive of the day with the Blackstone CEO. Danny, good morning.
Good morning, Manus. Thank you so much. That's right. I'm here in Paris. I'm sat with the Blackstone CEO and chairman. That's, of course, Steve Schwartzman. Steve, thank you so much taking time out of your world tour to talk with us here in Paris. Look, we are here in Paris. We're here in Europe the week after an ECB hiked rates, confronted with sticky inflation, weaker growth. The risk is constantly changing. How do you think about risk in this European region?
Well, I think Europe is slowing down. It's pretty clear that there's certain countries, for example, Germany, where I was yesterday, where growth is slightly negative. I'm in France today, We've got expansion of our office here. And France is doing the best of the European countries, and I think has been the biggest beneficiary of Brexit. I think the government's done a great job making France attractive, Paris attractive. But as the central bank continues to raise interest rates, no one ever knows where these things stop. It's certainly suppressing growth. So I think it's a reasonable expectation for Europe over the next year to have pretty muted performance.
Does the ECB need to stop soon for fear of not just being muted, but a full-on recession?
Well, that's up to Christine, not to me. I think the inflation's still pretty high here. It's in the 5s, and you can't stay at that level. And so the central bank typically would do what it needs to do to lower that.
Steve, ever the diplomat. One source of support for Europe, though, that we don't have, that we thought we would have at the start of the year is China. We came into the year thinking China would be this huge source of global growth. Now we're just hoping for more large-scale stimulus. Have your assumptions about China changed this year?
Well, I think they did change. I was in China in April, and my expectation was that there would be a pretty rapid bounce back. But what I found was that people really had a tough time over the last 3.5 years. They had a real estate crisis for a while, and that became more pronounced as they actually had to meet maturities. And the Chinese people tend to put 80 to 90% of their savings into real estate. So when real estate goes down, it really takes away confidence, because nobody likes spending a lot of money as their net worth is going down. It's just not how humans work, whether they're Chinese or any other place. And so it's difficult for China now, in the face of that, to have the kind of rapid growth rates that we're having. And Europe has been a big exporter to China. China has provided, over the last 10 years or so, before COVID, probably half of the world's growth.
So what does the opportunity set look like for Blackstone in China then? Is there still opportunity, or do you need to wait?
I think most people, including the Chinese, are taking a wait-and-see type of approach. One of the things with China is they often make mistakes, but they typically don't continue making them. And they don't have a lot of pride in wrong decisions, and they're practical. And so it's, in a way, a matter of time before they make the appropriate adjustments and start growing again. But in the short term, I think it's going to be somewhat difficult.
Steve, if I can take you back around 4 decades, when you founded Blackstone, just $400,000 in pocket and capital, to now $1 trillion. How do you get to the next $1 trillion?
Well, we just keep doing what we're doing. I didn't realize that 1 trillion was an ending point of some.
Certainly sounds nice.
Yeah, well, it's nice, when you start with nothing. We've got a market cap now of $140 billion. We're the 5th largest financial company in the United States after J.P. Morgan and Bank of America and Wells Fargo, and we're not a bank. And at some point, we'll be the 4th largest and the only non-bank to do that. I don't manage anything to a number. We're in the business of creating great products for institutions and individuals so that they can perform better than all other alternatives with safety. That's what we do.
Well, with that number, you definitely get more attention, though, and perhaps even more scrutiny. Jamie Dimon, for example, specifically called out Blackstone, talked about your industry altogether, but Blackstone saying you'd be dancing in the street about new banking regulation, that you would step in and do more lending, more private credit. Is he right? Were you dancing in the street after more banking regulation, Steve?
I like going dancing regularly, but not in streets. So we're just doing what we have been doing for a while, and it's been very safe for our customers. Very good performance with all of our debt products. As we look to the future, credit has been the most rapidly growing part of our business for the last 3 years. And to some degree, that's helped by central banks increasing the rate. So credit is now very competitive with other equity type products, and it has the virtue of being much safer than some of the equity products. But these things actually are cyclical. And when interest rates go down, real estate is really going to pop in terms of value and growth, and it'll also positively affect private equity. So for those of us who've been through at least 6 cycles, you look at all of this with a little bit of balance, and I think we're going to have a lot of opportunities for the firm to be growing.
To that point, I mean, you have a lot of men and women investing right now who have never lived with 5.5%. You've lived with it. You lived through higher rates. What do they need to understand about investing right now in a higher rate regime?
Well, I think you start thinking about alternatives in the sense, and I mean alternatives within different things that you can do. That you can invest in certain credit products and get a 10, 11, 12% return with very high levels of safety. You learn that when interest rates go up, certain things you thought were wonderful become unappealing. Some of the super high-tech companies where people were buying them at multiples of revenue. I always know that that's a bad moment when somebody tells you can buy something at 10 times revenues and the market's trading at 15, so you got a bargain. The fact is, it won't hold that value when interest rates go up. So you have to learn what fundamental value is. I know that sounds old-fashioned, but the people who don't do it really suffer. A lot of the venture stuff is down 50%. I think some of it's down a lot further. And so you learn to be in touch with more of what's safe with growth as opposed to just anything works. For some period of time, everything did work.
Are we still overvalued, though, in those pockets that you're concerned about? Or has the valuations coming down in the venture space, has that normalized now? Are you still concerned we're still askew with fundamentals?
Well, I think we're probably still a little optimistic. You have to get through a cycle to see, where things will really be worth. A lot of venture business, where I'm not an expert, but it struck me that ever-increasing markups with no cash flow, ultimately, every time I've seen it, that stuff really goes down. And we're in that cycle.
How steep of a downturn are you expecting in this cycle in terms of a recession? Are you expecting one? Are you preparing for one?
I think we're going to do pretty well this time. We have very low unemployment in the United States. And that kind of environment is tough to have a serious recession.
What about a fiscal accident causing something?
Well, you can always have a trigger that really affects markets, which will affect an economy. We're running huge deficits, and we have more fiscal problems than we do normal business cycle problems.
Steve, you're asked very frequently about who you're supporting for the GOP, and I don't want to ask you that because I know you frequently say I'm looking towards the next generation. I want to ask about the next generation. Do you see that rising stars? Are you optimistic that there are those there who can carry the mantle?
I've learned there's always people who appear, who you had no expectation, So when Barack Obama was elected as senator, it wasn't even within a year where he started running for president, and he became president soon thereafter. You know, there are other people who will come and do that. American politics, I've found, at the presidential level is pretty volatile. The people you think are going to win, whether it was Hillary in 2016, they didn't win. Other people who were no place, you know, they end up winning. And you know, in 2015, about where we are now for a presidential election for the Republicans, you had the governor of Wisconsin in the first place. You had Jeb Bush in second place. You had Rudy Giuliani in third place. And by the time there were 2 or 3 primaries, they were all gone. And somebody named Donald Trump won, who wasn't even in the game. And so I think all the straight line predictions of what's going to happen, I sort of just sit back and say, I've seen a lot of volatility in my life of what the public wants. You know, apparently the public is not that interested in really older people.
Right.
I think there was a survey that said 77% of the people didn't want Biden to run again. And so when you have that kind of situation, usually something else happens.
Right. Well, Steve, I hate to put it in this light, but you're only a few years younger than the current president and the former president. How are you thinking about your legacy right now?
Geez, I don't think about legacy. You know, I may be a little delusional. I still think I'm younger than apparently you do. So as long as I have really high levels of energy, and I'm fortunate enough to have a simply amazing person, John Gray, who's president of the firm, who does stuff that I used to be doing. You know, I love what I do. It's fascinating. You know, it's global. We're learning all kinds of things every day. Plus, I have a very interesting philanthropic life, and also involved in the political world. So for me, those 3 things certainly beat retirement. What would I do?
Yeah.
You know, this is so stimulating. Yeah. Plus, if I get a chance to meet you, I'm here in Paris. You know, I have a certain enthusiasm, if you will.
Steve, I may be a millennial, but I know age is just a number. Don't worry. Thank you so much. Unfortunately, we're out of time. A pleasure to speak with you. Steve Schwartzman there. Manus, with that, of course, the Blackstone CEO, Steve Schwartzman. I mean, just interesting to hear him speak about all sorts of volatility, be it political, be it rates volatility, and sort of that hindsight and that history helping you navigate, again, both the politics and these markets.
It's fascinating to hear Steve talk about the cycles, and when this rate cycle ends, and we'll find out a little bit more from the dot plot tomorrow night, when that ends, you know, property will pop. It's not necessarily popping at the moment. It's becoming harder, and of course, higher rates. Danny, lovely line from Steve there. Higher rates. Where else do you want to be apart from, you know, high-grade credit? Great conversation. It's good to know I'm not the only one that sort of, you know, wants to keep on going, keep on motoring. Great conversation, Danny. How to make the head of Blackstone smile. Danny Berger and myself. We'll continue the conversation in just a moment. Danny in Paris, I'm in New York headquarters. And coming up on the show, another exclusive interview with the private capital titan. We catch up with the Oak Hill Advisors CEO Glenn August joins us later this hour as the OECD just released their latest economic outlook, raising the 2023 world GDP forecast and cutting 2024's. We'll hear from the OECD's chief economist in the next hour at 6:15 a.m. New York time. That's 11:15 a.m. if you're in London. Plus, UAW warns of additional strikes if progress isn't made by Friday as the walkouts enter day 5, right here on Bloomberg.
investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. Yeah. There's nothing closer than the phone in your hand.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I found myself in a spot where I was constantly getting new challenges. A lot of, I think, the best mentorship I had at Bridgewater is because people often saw in me the potential to do things I didn't even see in myself yet.
This is Bloomberg Brief. I'm Menace Cranny in New York, Danny Berger in Paris, where she's been speaking to the leaders of private capital. And we will continue that conversation in just a moment. To our main story this morning, the United Auto Workers Union says it will expand its strikes if serious progress isn't made in negotiations. Oliver Crook joins me now. Oliver, where are we on these negotiations? It sounds as if it's fighting talk now at this stage. They're ramping up and roaring. Good morning.
Absolutely right, Manus. We're stuck at that 20% proposal from GM, Ford, and Stellantis to the union, which yesterday the president of the union, Sean Fain, said is a no-go. So what he said yesterday, he did a sort of media tour saying the ball is in their court and they need to come up with something better, and they need to do it before Friday at noon when they say they could expand this strike. And let us remember that we have less than 10% of the union that is striking right now. We're talking about 150,000 people potentially. If they wanted to, they could basically totally paralyze all of the big three North American operations if they decided to go that route.
Get down to business and work with us to make progress. Those are the words of Sean Fain, of course, who's leading this. He's almost become like an evangelist icon within this strike action. That's threatening to spill out of the United States. So what's happening north of the border in Canada?
Yeah, so just over the river from Detroit, you have Ford plants, you've got an assembly plant, you've got 2 engine facilities, and you have the union there. Their contract expired just a few hours ago. They are in negotiations right now with Ford. They want better wages, they want pension guarantees, and they want guarantees around EVs, which is really the music in the background of all of these conversations about the future of the industry. They said that they had substantive offer from Ford, so they've extended that window. They're not walking out. They've told everyone to stay at their jobs for the next 24 hours. But if they could, that'll hit the V8 engines. That goes into the Ford F-150s and in the Mustangs.
Okay, Oliver, I've got an image of you in a Mustang driving north of the border. Oliver Crook there, with the very latest on the auto workers and the messages coming from the unions to the bosses. Coming up on the show, it's an overhaul at Santander. We discuss the changes that are in store and why the Spanish bank is revamping the corporate structure. Will it deliver? Right here on Bloomberg.
sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority.
Another day, another structural overhaul at another bank. Today, Santander, the Spanish bank seeking to simplify the business and reach its profit targets with measures including combining the retail and the commercial banking divisions under a new global unit. Bloomberg also learns that the change is likely to reduce the management layers and may indeed lead to some job cuts. And you just think, yesterday you had a big revamp going through.
Capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries. The moment news breaks, 24 hours a day. Bloomberg, your global business authority. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Welcome back to The Brief. I'm Manus Graney in New York. Danny Berger on tour in Paris, speaking to the private capital titans. Here's what you need to know. The oil rally gathers pace. Brent touching $95 for the first time since November. Chevron's CEO tells Bloomberg $100 is in sight. Job cuts could be on the way at Santander. The bank revamps its structure as its new CEO looks to simplify operations. Plus, we keep that private capital party going. Earlier, Blackstone CEO talked Europe, China, and recession risk. Up next, we hear exclusively from Oak Hill Advisors CEO Glenn August. But first up, let's give you a taste of what's going on in the risk markets this morning. You've got that Brent market above $95, again, for the first time since November last year. Ed Moore says geopolitics alongside technical trading could cause this market to top out. We listened to the Saudi oil minister yesterday, north of the border here. The jury is out on Chinese demand and rejects the notion that we're going back to the 1980s of pumping up prices. 10-year yields at the moment. The bond decision comes in with Alliance Bernstein saying, buy these bonds. This is the time. It's ripe to buy. You'll make 20% on your bonds between now and the end of next year, going to 2.5%. SPUs are flat at the moment, up an eighth of 1%. Oil, of course, it's got the musculature of sort of pushing in against the consumer. But the other side is the best performing index here. It is the energy complex with Halliburton, Conoco, and Exxon all pumping higher through the month. Danny, good morning. Well done on making Mr. Schwartzman smile. What's your top takeaway?
A few, but I think one of the most interesting, Manus, because you and I have talked about this for a long time. In a world where we no longer have base rates at zero, what is the new regime when it comes to investing? And it was just interesting to hear from Steve Schwartzman say, look, it's all a cycle. Things come in and out of favor. So at the moment, while there are all the concerns about real estate, he said, look, real estate will come back. So it's interesting to have that perspective in mind.
It is, and I think the essence of that conversation was he's lived through a number of cycles. Our next CEO has also lived through a number of cycles, which is high-grade credit. It's really rich, it's really appealing. You get 10, you get double digits and higher in high-grade credit in this rising rate environment. But of course, he has lived through a number of cycles, and he talked about property and he talked about recession risk, didn't he?
Yeah, he also talked about Europe specifically. Of course, I am here in Paris. We had to start with it. And Steve Schwartzman talked about the idea of slower growth and the U.S. avoiding recession. Take a listen to what he had to say.
Europe is slowing down. Inflation's still pretty high here. It's in the fives, and you can't stay at that level. And so the central bank typically would do what it needs to do to lower that.
Well, let's continue that conversation and the theme with Glenn August. He's the founder and the CEO of Oak Hill Advisors. Glenn, thanks for getting up early. Thanks for making it into the studio. You're listening to Schwartzman there talking about the resilience of the United States and the concern about Europe. Where I want to start the conversation with you is, Danny and I are looking at financial conditions tightening. The consumer, on the consumer side, not your world, is finding it harder and gloomier on access to credit. Through the prism of Oak Hill Advisors, how does the credit landscape look for you right now? Is it getting tighter?
No, I would say that there is more opportunity than it is tightening. Certainly the banks have pulled back structurally over the last number of years, but there's an extraordinary amount of capital available for companies. The lower end of the consumer side of the market is definitely tighter, but there is so much liquidity. There was so much stimulus, and that's really setting up for a pretty extraordinary credit environment.
So when you use the word extraordinary, what went through, Danny and I caught up before we had these conversations, so you use a word like extraordinary environment. That says to me we're nowhere near the top of the credit boom for your part of the world and your industry. So do we grow significantly from here? Because the banks are coming in and snapping at your heels, aren't they?
Well, the banks really have been held back by regulatory concerns and capital concerns, and they have really evolved into more of a syndicator as opposed to a principal investor, certainly in larger cap credit. And so when I say extraordinary, I just think that the opportunity to earn double-digit yields, which has been reported certainly broadly, is an extraordinary opportunity. Again, as you mentioned earlier, Steve Schwartzman mentioned earlier, when we were at rates of 0 and spreads were 4 or 5%, you were only making 4 to 5%. And today, the opportunity to make genuinely double-digit yields with a 5% plus base rate and spreads of 500-600 basis points, you have the opportunity to make 11+% on an unleveraged basis for senior secured risk, which is lower risk. And we have not had that opportunity really in decades. I've been doing this now for 36 years, and it was really back in the late 80s when base rates were much higher and you could make double-digit yields. But today, the opportunity to make, again, 11, 12 unleveraged returns in senior secured risk feels extraordinary to me. And to your question of growth, I think this is structural. I think we're here to stay because the opportunity set, because the banks have pulled back and the evolution of private equity is such that the demand for credit is there.
To that point, when you have the world awash in debt, $300 trillion worth of debt, what are the consequences of more of that moving out of the banks and more into you and your peers' hands? What will be the outcome of that ultimately?
So the question is not the magnitude of debt, in my view. The question is the structure of the companies that we lend to. And when I started in this business in a typical private equity transaction, you'd have 5, 10, 15, 20% equity in a transaction. Today, you have 50% or more. That amount of cushion gives us substantial comfort, and I think it really does change the risk-reward profile of credit.
Yeah, I heard something similar from the ICG CEO this morning too, Glenn. What then does a recession need to look like to be actually bad for credit and for private credit? What type of recession would you see a downturn in the space?
So, again, if I look back over the last 3+ decades, we've had a few major recessions, right? We had the 91-93 recession. We had the 01-03 recession. Obviously, we had the global financial crisis in 08-09 with the deep recession. I think it needs to get to that order of magnitude to have a meaningful impact. If you think back to 2008 when equities went down 30 to 40%, that's all it went down. And if you have 50% cushion and you've done your underwriting appropriately, we think there's substantial cushion. And I often tell the story that if you looked at our portfolio in June or July of 2008 and went away for a couple-year vacation and had no access to your phone or any internet, and you came back, we made over 35% over a 2.5-year period. And in our defaulted situations, we recovered 95 to 98 cents of our cost. So it really, in credit, like in equities, it's about selection. And I think there's a great opportunity to differentiate yourself in credit selection.
Glenn, where would you, I mean, if we take the landscape that everybody's spoken to Danny and I about, which is another rate hike, a soft landing, if I hear that word again, I think I'll sort of take the day off and go to the beach. But everybody's built this consensus narrative around this. So with that in mind, are you very comfortable with, let's say, U.S. exceptionalism in this soft landing scenario on the credit side relative to perhaps the EU or the European credit market or the UK credit market? Does U.S. exceptionalism hold in the thesis you've just given us?
So I don't think you need exceptionalism. Let's just start there. Whether it exists or not, we could debate. But what I would say is in a world where there is slow growth, where there is a world where there's substantial cushion, that I think the credit outlook is very good. And there's not a lot of maturities. There's an abundance of capital to provide liquidity. And so I think the U.S. is in very good shape. And even if it worsens, I think there'll be substantial liquidity available to provide capital to those companies that need it. In the European market, I certainly share the view that there's more challenge there, but more opportunity. It's a different type of market given the the fact that the banks really have never cleaned out their balance sheets from 2008, 2009 in many respects. And structurally, there's more regulation. And so I think there's actually a pretty interesting special situations opportunity emerging in Europe.
Okay, stay with us. We'll pick up with the first question on that, and where are they, and what shape are they? Glenn August, our guest this morning, staying with Danny and myself, more about the booming credit market, private credit market, in just a moment, right here on Bloomberg. From New York and Paris, good morning.
To the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
On the next episode of Hello World, meet the women driving Kyrgyzstan's tech revolution.
This is the first satellite in our country.
And some speedy horses. Watch Hello World Thursdays at 8 p.m. Eastern on Bloomberg Originals or 10 p.m. Eastern on Bloomberg TV.
As we look to the future, credit has been the most rapidly growing part of our business for the last 3 years. And to some degree, that's helped by central banks increasing the rate. So credit is now very competitive with other equity-type products, and it has the virtue of being much safer than some of the equity products.
Blackstone CEO Stephen Schwartzman speaking to Danny Berger in Paris just a little bit earlier this hour. Listening into that was Glenn August, founder and CEO of Oak Hill Advisors. You two must be on the same hymn sheet, which is, rising rates, get yourself stuck into high-grade credit. It's like bish, bosh, bosh. You talked about Europe just before we went to the break, and I'm curious to know, with Nouriel Roubini here yesterday, lambasting Europe and talking about stagflation, slowdown, Germany, sick man of Europe, etc. Yet you say there are big opportunities to come in Europe. Where? Is it in leveraged finance? Is it in private credit? Where's the biggest growth in Europe and the biggest opportunity? Glenn?
Well, I think it's two places. One is, given that the banks are under regulatory pressure, I think to the extent that companies do face challenges from a very substantial weakening in the economy, obviously a soft China, has a big impact on Europe. I think there's going to be opportunities to lend money into companies that need capital. That's number one. On a special situations, liquidity financing type of background basis. Secondly, we've talked a lot about the private credit market in the U.S. evolving over the last few years, such that 75+% of all larger transactions now involve private credit. And again, I don't think that trend is changing. Europe is somewhat behind, and I think that trend of providing private credit in new transactions is going to be a very, very powerful one. And so, again, I do think we're in this great era of private credit with high base rates, a relatively neutral economy in the U.S., challenging opportunities in Europe, but both special situations. And the whole idea that credit is basically attractive on a relative value basis to every asset class is really the first time you've seen that in decades.
And sectorially then, let's dig a little bit deeper into that. In Europe, if you're going to build out, are you going to be a little bit more guarded in terms of how you lend in Europe? Just run us through that growth strategy and maybe the parameters around that. Because if you're going to go into a fairly tough or a bumpy landing there, the opportunity to lend is there. But of course, the other side of that trade is perhaps the risk rises.
But you need to understand the structure of the market. The leverage finance market in Europe, actually, high yield market, is actually about 65% double B. So it starts with a higher quality market than the U.S., which is 50% double B, which, by the way, is materially better than it was decades ago. And so from our perspective, the big difference is you have maturities coming due in the leverage finance market in Europe. And again, if there's not regular way capital to provide that refinancing, we think there's going to be good opportunity for new capital to come in. And obviously, in everything we do, you need to be incredibly selective. We're not blind to the idiosyncratic or the macro challenges, but that doesn't mean there aren't high-quality companies that need capital, and rather than accessing the public markets, they'll access the private markets.
Glenn, I can't help but wonder, with this space becoming more popular, fundraising rounds getting bigger and bigger, is everyone being selective, or do you see managers who potentially chase deals because they had to put money to work coming under pain in the coming months, coming years?
So a few things. Number one is there is certainly a growing supply of capital that we have and our peers and competitors have. But there's also an extraordinary amount of demand. One of the things I like to talk about is the evolution of the leverage finance market. And today's market is such that the syndicated loan market is predominantly executed through CLOs. The U.S. high yield market is predominantly double B credit. And so when large private equity deals get done in growth equity type of industries, they need to access private markets. So first of all, there's a great demand, and that demand and supply is actually setting out to a place where we think there's good value. Secondly, we have been in a world where there has been very, very little differentiation of managers and of performance because we've been in a benign backdrop. One of the things we like to highlight with a firm that has a 30-plus year track record is we've navigated the ups and downs. At the end of the day, we will see some of the new entrants, whether or not they can navigate a more challenging market when that market comes. In the interim, there will probably be less differentiation, but we think over the medium term, as things do ultimately soften, there will be more differentiation.
What are the consequences of that, Glenn? Could there be consolidation among managers?
Look, I think you've seen consolidation in the alternative asset space. Ultimately, there's been mega trends where the largest investors in the world have decided they want to have fewer managers and much deeper relationships. And so those investors want to work with partners that can provide them multiple products. So I think you'll continue to see product consolidation. Secondly, there's clearly a mega trend going on in the wealth channel where the individual investor has been underinvested to alternatives. One of the comments I like to make is, why should the dentist in Texas not have alternative exposure, but the teacher does. And that's because the teacher has a teacher's pension fund, whereas the dentist is doing his or her own investing. And so I do believe this mega trend of individual investors getting access to alternatives is going to grow. So I think you'll see channel consolidation. I think you'll see product consolidation. Clearly, one of the other mega trends is exposure to alternatives in insurance companies. There's been lots of transaction activity and products getting customized to service the needs of large insurers. And so the alternative asset space, and again, I've been doing this for 36 years, continues to evolve in a very exciting way. And I think there will continue to be meaningful growth in the sector.
So the mega trends, and you've been through a few cycles to say the least, Glenn. With that in mind, there's an obsession. I mean, I've arrived in New York, blown away by the property market here. I'm a broke man, and it's day 7. But on a much broader scale for you at Oak Hill Advisors, Bank of America wrote that the boa constrictor around the U.S. economy was commercial property. People are tuning in, 5:49 a.m. in New York. Let them walk away with your view on property, on exposure to that. Where are you taking more? Are you prepared to take more? Do you have a big megatrend view on that?
So I would say that we are cautious. Unlike corporate credit, which is relatively stable in a benign environment, I think we're still processing a few things. One, the secular changes in real estate. Obviously, office is one segment, but business, hotels, and so on. So this COVID chapter we've all been going through over the last few years is having its implications, and we don't know where those ripples end. That's number one. Number two, with rates up materially, the value of long-dated cash flows is lower. And so the cushion that's in real estate today is less. And thirdly, the capital markets today in real estate is somewhat broken. The securitized markets are much more challenged. There's lots of debt coming due. And so I do believe there will be real opportunity, but I still think it's a little bit early. We're looking at lots of things on a relative value basis, and we're ultimately all about maximizing risk-adjusted returns and finding attractive relative value. We think in real estate, we don't see it there just yet.
Okay, Glenn, that's a thought for the day for our viewers from Paris, New York, and London, and around the rest of the world. Glenn, thank you very much for getting up early and joining Danny and I. Glenn August, Oak Hill Advisors, CEO. Coming up in the show, a look at some of the market-moving events to watch throughout the day, right here on Bloomberg, as New York wakes up and gets set on Bloomberg.
What is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO. So buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Brief. I'm Menace Granny in New York. Danny Berger in Paris, where she's been catching up with Mr. Schwartzman at Blackstone. Danny, good to see you this morning. You get the glamorous tours, but I'm very happy to be here. Look, we didn't get to the China conversation with Glenn August. We decided to go down the route of property. But Schwartzman's take on China, I think, is interesting. It's about confidence and the lack thereof and the hammering that people have had in the property market.
It's true. And look, he expressed those concerns about the property market. And when I asked him, okay, what does that mean for Blackstone? How do you invest in that uncertainty? He said, look, us and most people in China are in this wait-and-see approach. But he was confident that China growth would come back. But it's interesting, you can't quite time that, right? It seems to be what he was saying, that you can't time it. So in the meantime, you just kind of have to wait. But elsewhere, Manus, we've seen survey, we've seen the flows. The world is quite dour on China at this moment.
Yeah, and we didn't actually get that far with Glenn, but of course his viewpoint of the world was around Europe, where he sees special situation. He's going to be a little bit guarded, but he sees the opportunity. It sounded like almost a bigger opportunity for him in Europe. Yes, you've got the safeguard of the US, but Europe seems to be the land of where he sees, well, not so much milk and honey, but the opportunity. And then, of course, in property, a little bit guarded, I thought, on the comment there.
And it has to do also with what the banks are doing, too. I thought that was an interesting dynamic of him talking about the banks retrenching. So liquidity is needed. So that's where folks like Oak Hill, the rest of the private credit space, where they can step in and find opportunity.
Okay, well, listen, we can reset the agenda tomorrow. We're going to get back to basics with markets because, of course, it is Fed Day. We'll see what that old dot plot gives us. Will it guide us to 4 rate cuts next year? Bloomberg Brief will take you through it. We've got Seema Shah, Principal Asset Management. Paul Donovan, UBS Global Wealth Management, joins the brief tomorrow. And that's it from New York and Paris. There's special coverage of surveillance. They're live in London with the OECD's chief economist, amongst others. Good morning from New York. Good afternoon from Paris.
This is Bloomberg.
Looking forward, the jury's still out on inflation, but that recession risk remains significant.
Might take longer for inflation to get back to target.
It's true there is a resilience of inflation which is more tangible in Europe than it is in the US.
Consumers in particular, they aren't behaving like there is a recession in any form coming around the corner.
There's a risk here about a wage price spiral that isn't going away anytime soon.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
$95 crude, live from the City of London for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio, alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Counting you down to that Fed decision, two-day meeting begins today down in Washington, D.C. In the equity market on the S&P 500, positive by 0.1%. TK, we go to the commodity market. Right now, Brent, 94.93.
And the quiet of the market and the rest of the market is quiet. I completely take your point. Oil's game-changing here in the last number of days, and it's not $95. It's how we got here. Can you imagine 97? Why can't you extrapolate it out on the edge of $100? Javier Blas' Saudi Light right now is at $100 a barrel.
Up by 0.5%. What does it influence? What does it change? Lisa, I think we've got to ask that question for the Federal Reserve going into tomorrow. Does this change anything for policy, for their forecast into next year?
Ellen Zentner says no over at Morgan Stanley. And then you have Mark Zandi over at Moody's coming out and basically saying it could be a game changer. And they're actually saying anything over $100 for any length of time, and we're going to be very sick. So on one hand, you have to think about what this might do in a disinflationary way, but also what this does to goods pricing, as Mohammed El-Arian was saying to you.
Game changer for inflation or game changer for growth? Which one?
It's a great question. We don't really understand. I don't really understand what the major driver here is. Is it the demand side or is it the supply cuts? Is it both? If you have demand holding up, then this is potentially an issue for inflation. If you have this really being driven by Saudi Arabia and supply cuts, which they basically reaffirmed yesterday, then you know what? You could see it really take a hit to growth.
I'm going to dovetail two research notes this morning on this. Lisa, you're out front. You mentioned one of them, Morgan Stanley and Ellen Zentner, John, with a real gap down in presumed U.S. GDP. Ellen goes down 50 basis points, half a percentage point, to almost what's called a full stick down on real GDP. That's a drop. And then to Lisa's observation, Dominic Constam over at Mizuho makes real clear how far are we beyond the pandemic supply economic shock towards traditional demand economics.
So let's work through the calendar. Federal Reserve decision tomorrow, going through to Friday. We've got a new deadline. Let's talk about that deadline. Noon Eastern on Friday. This from the UAW president. He wants to see serious progress by then.
Yeah.
He had this to say: either the big three get down to business and work with us to make a deal, or more locals will be called on to stand up and go out on strike. Lisa, are we inching towards a bigger, a more prolonged strike here?
Well, it's unclear what negotiations have actually been going on so far. So yesterday we were talking about $21 from Stellantis, and now it comes out that had been offered before the strike was waged. There has been no progress made and no new offers from the auto manufacturers, according to the UAW. Unclear what the threshold is to mean serious progress at a time of these kinds of negotiations.
It's an original path, and I'll be honest, like you, Lisa, I just simply don't get it. What's the auto response? And can we just say that we're in early days of it could be weeks or months? I don't know.
It feels that way.
Yeah.
The Detroit Three just look dazed and confused.
We mentioned NHS and the doctors here in the United Kingdom. Times of London this morning. Are they going to order the junior doctors, the interns and residents back? Here, there's a story. I'm not sure what the story is in America.
It's a very different labour market. Yeah. Lisa's going to go through the day ahead for you in just a moment. Just to touch base and give you a snapshot of the price action currently. The equity market elevated by 0.1% on the S&P 500. Still in the 430s on a 10-year. Yields up by a single basis point, 431.66. Lisa, crude, WTI, 92.63, up by 1.26%.
Yeah, the big mover is everything else is in stasis ahead of the Fed meeting. Today, President Biden is heading to further clog up traffic in New York City at the UN General Assembly. He's going to be speaking reportedly this morning at some point. Curious to see how he tries to imbue this event with some relevance, as a lot of major leaders of other nations did not show up. Then at 1 p.m. Eastern today, we do get U.S. Auctioning off $13 billion of 20-year notes. These tend to be messy auctions. bonds. Very curious to see what this does to longer-term bond yields at a time where you already see it creeping towards some of the cycle highs. And today, there's so many meetings and conferences on the sidelines of the UN General Assembly. I mean, it's just there all these sort of, yes, exactly.
Yes.
Bilats. Would you like to have a bilat with me?
No, the bilat this
Isn't this our
afternoon.
regular bilat?
The bilat
what this is?
the UN this
Televised
afternoon.
bilat.
The UN this afternoon, the bilat is Newcastle AC Milan. That's
is
the
that so?
bilat.
Are you coming round to my room? We're going to watch that together.
I got to go to the dark side. Our boys from Arsenal.
You can go to Janet Yellen's room because she's holding a bilat. Actually, she's speaking at 4:05 p.m. Eastern at the Transition Finance Action Forum. There also are other speakers, including European Commission President Ursula von der Leyen, HSBC CEO Noel Quinn. Very curious to see what the word is on China, because you have the German Bundesbank coming out yesterday and saying it's really China that's the cause of our problems. It's our dependency on China. And Janet Yellen yesterday said there is no way that the U.S. and China can decouple. You put these two ideas together side by side could make for some interesting tensions.
Something tells me Noel Quinn's not going to come out and say the problem's China over at HSBC.
Probably as a safe bet.
Yeah, I think that's a safe bet. The complaints about traffic in New York yesterday, text after